Good morning, everyone. I'm Bridget Polachine, CEO of the IIB, and I'm very excited to welcome all of you to our virtual seminar on digital currencies. Finally, after a year and a half, we're hosting an event that seems fitting to be held virtually. We have an impressive lineup of speakers to take us through some of the regulatory and business risks and opportunities digital currencies present to banks. We'll kick things off with Jim Kuna of the Boston Fed, who will talk to us about central bank digital currencies, a topic under active consideration and study by the Fed and all other central banks, it seems. Jim will be followed by various expert panels and legislative insights by Congressman Warren Davidson. We hope to make this session as tailored and as valuable to you as possible. So please submit questions via the Q&A function in your Zoom window. Each of our speakers and panels today have generously reserved time to answer your questions, and we really encourage you to take advantage of having this kind of expertise available to all of us. I also want to give a hearty thanks to our seminar sponsors, our diamond sponsors, diamond sponsors, Clifford Chance, Davis Polk, and White & Case. Thank you. And thanks to our Sapphire sponsors, Exeger, Gibson Dunn, and Guidepost. We greatly appreciate your support of the IIB in today's event. And now let's get started. We're truly honored to have Jim Kuna join us as today's keynote speaker. Jim is the Senior Vice President of Secure Payments and FinTech at the Boston Fed, where he leads the bank's efforts to study, explore, and engage with blockchain to determine applicability, potential benefits, and risks for internal and external uses. He's specifically focused on the evolution of the technology and its potential impact to the financial services sector. He is also responsible for the bank's digital currency research efforts, which is what he's going to discuss with us this morning. So Jim, with that, thank you. Over to you.
Thanks, Bridget. It's a pleasure to be here. As Bridget said, I'm Jim Kuna from the Federal Reserve Bank. Well, first of all, I'll give the normal Fed disclosure. These are my words, not necessarily those of the Federal Reserve System. But also just my background, so you know where I come from. I'm not a lawyer. I'm not an economist. I don't do regulation. I'm a payments and technology guy. So I spent my entire 37-year career at the Fed in payments, security, and technology. And that's where these come together really importantly here, talking about digital currency. So I'm responsible for two things now. One is to work with the industry to help reduce fraud in the US, payment fraud, and also our digital currency experimentation and research, which I'll talk about today. There's a lot of slides here. I'll go through quickly, but if you have a question, feel free to enter it. And I've asked Bridget to interrupt me if the question is germane to what I'm talking about, and I'll leave time at the end for lots of questions. So if we can go to the next slide. Next slide for the agenda, please. So here's the agenda. We're going to talk about central bank digital currency, just a brief moment on what they are. Then I'll talk about retail CBDC and wholesale CBDC. And also I've thrown in stable coins because they are so related to wholesale, but also what central banks are looking at relative to central bank digital currency, and a few comments about some other things going on. So we can go to the next slide. Just as a level set. So a CBDC would be a digital currency, fiat currency, just like paper currency issued by the central bank. I said it could be legal tender because there may be some legislation required before it's actually deemed legal tender. It is a liability of the central bank versus, as you all know, commercial bank money, which is a liability of the commercial bank. I'm asked a lot, how do you keep it pegged to the dollar? Because people know that cryptocurrencies often fluctuate dramatically. And the answer is simple, is because it is a dollar. It's on the exact same status and par with paper currency. And there's two modes: wholesale, so just think of RTGS, wire transfer, in general purpose. This is similar to paper currency, but also because it's digital, it also could act much like credit, debit, or any other type of electronic payment. So go to the next slide. So retail CBDC. So really we're talking about point of sale, person to person, but also e-commerce. So this slide talks about what's happening around the globe. And there's a lot, over 80 central banks doing some sort of research into central bank digital currency, CBDC, on either retail or wholesale. Most of this has really been going on just for the last 3 or 4 years. So it's really a fairly new topic. And the one thing you'll learn from this slide and the next is that it's not homogeneous. CBDCs aren't just one thing. Central banks are looking at different technologies. They're looking at different reasons for issuing, and I'll cover a few of those here so you get a sense of the scope. So China, by far, is the farthest along. They are in a production pilot, I believe in 10 cities, and their goal is to be fully operational before the Beijing Olympics. And they started with distributed ledger technology as their base, and then they moved to more, if you will, traditional technologies. Bahamas has a SAM dollar in production since October, and then also the Eastern Caribbean. So what's different about them is that their motivation is because it's really expensive to move paper currency around the islands. So their game really is efficiency. Sweden's been at this a long time too. They've hired Accenture, and they're using a distributed ledger platform called Corda, and they're in a pilot test mode here. Sweden's motivation is that paper corona is barely in circulation. And so they believe that the central bank should be in the digital currency game for fiat currency. So they believe that they may have to issue digital just to be able to have a currency in circulation within the country. And as you can see, major countries looking at this: Canada, ECB, Japan. Also, you'll find that different countries have different regulations, different rules about privacy. So there's a lot of differences, but there are still similarities. But for instance, Canada and ECB are very interested in the privacy aspects of CBDC. Japan is interested heavily in offline because of the number of natural disasters that affect that island nation. If we go to the next slide, you'll see that these are just a few more of the many that are in production. And Ukraine's an interesting one because instead of building their own digital currency, they did something that's called a synthetic. And what they did is they took an existing digital currency and basically tested it to use as their own country's currency. So it's a little different than what others are looking at here. And most of these, other than the 3 I mentioned, have no specific plans for production. So they're just trying to understand what's possible. Should we go to the next slide? Talk about Project Hamilton. So just a little more on motivations. So we started experimenting back in 2016 with wholesale. We were amongst the first in the world, along with Singapore and Canada and the UK. And we pivoted in 2020 to retail. And the reason was, I mentioned before, China was about to launch their own production retail CBDC, but also Facebook announced their Project Libra, now called Diem. And more importantly, in March of 2020, the US Congress had 2 bills that were not ever introduced, but they were introduced but not passed, that would have directed the Federal Reserve to create a central bank digital currency with accounts for every citizen in order to make COVID relief payments. So when all those activities happen, it really is important for us to be ready for action whenever that happens. So Project Hamilton is our way of trying to make ourselves as ready as possible if either we decide to act or Congress mandates that we act and issue a CBDC. So this is technology research. We're working with MIT's Digital Currency Initiative, and this is a group within MIT that is one of the most advanced in the world. They started studying cryptocurrencies and central bank digital currencies over 5 years ago. And they have some of the most advanced scientists looking at privacy, networks, and also most of the Bitcoin code, which is open source, much of that is maintained by this MIT DCI. So these are the experts of the world. And we believed if we were going to test a central bank digital currency, we needed to be really on the leading edge of technology. Anybody can put data on either a blockchain or in a database and call it money. And that's easy. But to do it at scale with the kind of throughput and privacy and protections you need, that's the hard part. So this is research. Research designed to see, can we build something that would meet the needs of the US? We're technology agnostic. Some central banks are going right to look at blockchain. We're looking at blockchain, but we're not necessarily focusing only on that with the work we're doing with MIT. Our goal is to publish our results publicly with MIT and then do something the Fed's never done. And I don't think any central bank's ever done either, which is we're going to create an open source license for the code so that anybody can contribute to it, can see it, can tell us what they like, what's wrong with it, and just build off it. So if we go to the next slide. So here's the project in a nutshell. There's two phases. So we are coding, my team is coding side by side with MIT. In the first phase, which we're almost complete with, is to build the core engine. So this would be the minting, the clearing and settlement piece, if you will. Because if we can't build the core engine at scale, then we shouldn't be going any further, because that's sort of table stakes. So scalability. We're looking at multiples of tens of thousands of transactions per second, because that's what we think we need in the long run in the US. Clearing and settlement under 5 seconds. Resiliency. This system has to be available 7/24, 365. It cannot go down, not for maintenance, not for issues. So we're looking also at, a cloud environment spread out across the US, which would not be susceptible to any single failure of any single data center, and a certain amount of privacy. So our goal is towards the end of the summer to release that paper and that technical research. And we hope that organizations like your own will be looking at it to help either contribute to it or at least look at it and tell us what you think. Then the second phase is to code and test additional software, additional requirements. Now, we don't have requirements yet because we have not had the deep discussion of policy, but we're going to test some of the most challenging policy outcomes different ways and see what we can prove with technology. So one major one is privacy versus traceability for AML, KYC, sanctions, et cetera, because those are at odds with each other. The more privacy you have, the harder it is to catch the bad guys. The more rich data, the more identity information you have, the more challenge it is from a privacy perspective or attack, et cetera. So we're going to code and test various things. Can we add functionality in with something called smart contracts? How do you go cross-border? How do you interoperate? How do you go offline? So all these things we'll be looking at over the course of the next year or two to see how far we can go with it. For two purposes. The first purpose is if you add more code, you will potentially slow the system down. So it's great if we meet our speed metrics, but if we add more functionality and can't meet those metrics, then we failed. And also because policymakers right now can only look at what's possible today, technologically, but with advancements, we may be able to give the policymakers more choice. We may be able to maximize privacy and still catch the bad guys. So there are technologies and cryptography we're looking at that may be able to actually build a better mousetrap that allows us to give policymakers more options. I'll also mention that besides this work with MIT, we're also looking at distributed ledger platforms separately. This is just the Boston Fed looking at distributed ledger platforms separately. We're looking at private sector actors. There are some solutions out there that say they can meet the needs of the US for CBDC. So we're going to be bringing those in and testing those in our own lab. So the overarching goal here is not to necessarily get to production because we don't have those approvals, but to be ready to move, should we be asked to act. As I mentioned, if Congress passed a bill and we weren't doing this work, the chances are we'd be 2 years behind. So this is just to prepare us and also to help educate other central banks. If you go to the next slide, I've listed just a few of the major policy questions here. You may have heard Chair Powell announced about a month or so ago that there'll be a public consultation this summer issued by the Board of Governors. And what they'll do is they'll ask different questions about these major policy and design choices and try to get input from the industry. So I encourage your institutions to comment if you've got positions. But the ones I think are most interesting to banks are privacy traceability, but the financial structure and distribution model. Is this distributed right to the public? Do we go through banks like we do today with cash? Are there other intermediaries? What's the impact on the financial systems and players? What we don't want to do is create harm to banks or to create any financial instability. So what's the impact on deposits? As you know, any deposit that leaves the bank reduces your ability to lend. So it's really important that we think about these factors seriously. And my job is to see, can technology help solve some of these potentials? And then on the bottom, innovation goals. I truly believe if we did issue a CBDC, there'd be significant innovation on top of it. I can see banks offering new services around the CBDC to their customers and others as well. So these are some of the major questions that we have to grapple with. But I'll leave the retail discussions there and move to the next slide on wholesale, which I think is a little more specific to folks here. And so if you go to the next slide, what I've listed here is, once again, just what's going on around the world. And much of this is tied not to just issuing a digital wholesale token, because many of these experiments and studies have said the ROI just for issuing a central bank wholesale token is not really there, because we've got good wire transfer RTGS systems today. The real benefit is when, as many people think, there will be securities on blockchains. So securities, bonds, notes, derivatives. And if you think about it, if you've got the ability to move securities very quickly via blockchain between institutions, it's a gap if you don't have money moving in the same way. So a lot of these projects are to see if we can put money on a blockchain or other systems for instance, delivery versus payment or payment versus payment types of processes. So that's the real goal here. And I know many of the larger institutions in this group are working on projects today that are looking at the securitization, the tokenization of securities. And that's what this is all here for. So a few of the major players, and each one of these has published extensively on their technology, on their research. So I really encourage you to go to Singapore for the Project Ubin documentation if you're interested in what they're doing. They've been one of the leaders. They started testing the same time we did here in the US. And what they've done is create a system and work with other central banks. They've done 3 different blockchain solutions, different ones, 3 different currencies between Singapore, Canada, and the UK, and did P versus P, payment versus payment, delivery versus payment, et cetera. And they've proven the technology can do that, not necessarily at scale, but they prove they can do it technologically with some new cutting edge technology. So a lot of exciting work here. The Bank of Japan and ECB did good work. And there's also the Bank for International Settlement has a number of innovation hubs around the world. If you haven't followed those, I'd encourage you to look at them as well. What they've been doing is taking particular topics of interest with small teams and then working with the industry to try to solve those problems. So for instance, the Hong Kong Innovation Hub is looking at cross-border wholesale digital currencies, working with Hong Kong, China, UAE, and Thailand. And so some really exciting work there with different solutions. Some solutions, you've got one major network with multiple currencies. In other cases, they're taking multiple blockchain networks and interconnecting them and moving money across those different technologies. So some really exciting things happening in the hubs. And the Swiss are looking at taking tokenized assets and central bank money and moving it on separate blockchains. So like I said, some really exciting things going on here. And I mentioned one more that's not a central bank effort, but it's a private sector effort. And I know some of your banks are actually part of this group. It's called Finality, Finality without the I. And this is a group of some of the leading banks around the world. I know that UBS, Santander, State Street, a few others are building a private network with a wholesale token to be able to move that token amongst those banks as final settlement. And the only reason they're doing it is because, as I said before, they believe that securities will also be on blockchains. And this token is how you pay for it. I've talked to some of these banks and they've said, if we had these types of solutions as central banks, they wouldn't need to do a private solution, but they don't believe the banks will be there soon enough for their work to be done. So really exciting project in the private sector called Finality. And if you look at the next slide, please, there's also a lot of work being done by the BIS, the Bank for International Settlement, on cross-border. There are 19 different work streams looking at cross-border today and some ways to try to improve it. As most of you know, even if you're in those networks, it's expensive, it's slow, it's not what you would build today if you're starting from scratch. And one of the work streams is to look at central bank digital currency. Now, for most of you in the financial services game, you know that the cross-border or any really hard problem isn't just solved with throwing new technology at it, because it's much more of a system with many complicated components. You've got legal issues, you've got risk, you've got FX issues, you've got all sorts of things, different actors with different tolerance. These cross-border transactions are also often linked to other financial transactions. And so it's a really complicated area, and CBDC itself or new technology won't solve it. But I think this is the most concerted effort I've ever seen to try to take these issues and work with them across dozens and dozens and dozens of central banks. So I showed this slide just to see what's going on, but also just to inform this group here in case you aren't familiar with the BIS work, because as international banks, especially in the wholesale space, I think some of this work could definitely have a positive impact on your day-to-day life. I think I did see one question that popped through that asked if these slides can be made available, and I'm totally fine with these slides being made available to anybody in the viewing audience. I'll also mention now, even though I'll bring it up again later, is I'm fine with people contacting me if they have specific questions after the fact about the slides or the presentation. So you can find me on LinkedIn, but I'm part of my job is to help make sure that I'm educating and getting rid of some of the clutter. I'll also mention that in this whole world of central bank digital currencies, like anything else, there's just a lot of misinformation and a lot of terminology that's used very loosely. And so I encourage you, if you're getting into this area more deeply, do your homework, look for the right sources, because there are many people that are out there pontificating that don't really know what they're talking about, or the terms are just used loosely. And so, like I said, it's a new area, it's a growing area, and there's a lot of people, a lot of systems. So I just encourage you to do your homework. Now, if you go to the next slide, I want to talk about stable coins, because as I'll explain, they really are making a dramatic impact very quickly on the markets, and they also have the potential for both extensive benefit and risk. So I thought, because it's so close to wholesale and retail generally, it's also very close to CBDCs, that was an important topic to talk about. And it's only a few years old, so it's actually growing quickly, which means it's evolving. So whatever you know about it today, it's going to evolve into something differently as you think about things tomorrow. So we go to the next slide. So what is a stable coin? It's designed to provide, as you would think, a stable value, usually pegged to the US dollar. If you followed any of the cryptocurrencies, Bitcoin, the Ether, XRPs, and then the silliest one, Dogecoin, they fluctuate dramatically. And someone once asked me, I was given an update to our board of directors of the Boston Fed, and within 3 minutes, they stopped me and said, I don't understand this at all. Why do they have value? And I said, because people think they do. And why do they fluctuate? I said, very simple, supply and demand. And so when you have that combination, you're going to have wild fluctuations in those currencies. So stable coins are trying to act like a digital currency, like a cryptocurrency with a stable value. Most are built with a smart contract. And what a smart contract is, actually it's an oxymoron because it's not smart or a contract. It's really computer code. And that computer code takes logic and embeds it in one of these blockchains so that it actually becomes part of the system. The code manages the contract terms of whatever the particular scheme is that's being built. So it's embedded right in the system itself. Ethereum is one particular network that was designed to run these smart contracts. So most of these stable coins are using that technology. And what happens is the tokens, these stable coin tokens, are backed by something. It could be different combinations of assets or one single asset, but the goal is to provide a way to have liquidity later if people want to get their tokens cashed in, which obviously, as you all know, means it's easier to keep the balance stable because people have faith in it. Now, these could be dollar deposits or other liquid deposits, securities, commercial paper, and then interesting enough, the stable coin could actually be cryptocurrencies themselves. Now, by definition, those probably aren't as stable as something that's backed by commercial paper or bank deposits, treasuries, et cetera. And then there's a really interesting type that is actually managed by an algorithm code. So what it does, it actually tries to buy and sell the tokens themselves. Like I said, supply and demand can affect the value of a token. So it can actually flood the market when they want to lower the value of the token or buy tokens up when they want to raise the tokens. They try to, much like the Fed tries to manage interest rates by buying and selling securities in the market, these stable coins try to buy and sell the coins to create a stable value. And these have different levels of stability. So not every stable coin is created equal. And also most stable coins, they should have some sort of an audit, because if you're trying to use a stable coin and expect it to have value, as a holder, you should have some sense about what are the assets and where are they and how liquid are they. That'll give you faith in the stability. So these stable coins usually, not always, have some sort of an outside firm audit the reserve and then publish a report. So that's a stable coin in a nutshell. Like I said, they've really only been around for a few years, and with most of the growth in the last couple. So we go to the next slide. This talks about, so what would you use a stable coin for? It could be an off-ramp or an on-ramp to cryptocurrencies. One of the challenges with buying cryptocurrencies is most of the exchanges don't have access to normal bank deposits, or the owners or the managers of these cryptocurrencies, because of the volatility, because it's hard to know your customer, because of the AML components, the banks aren't deeply embedded with these cryptocurrencies. So what you do is you would buy a stable coin, which would validate your know your customer, and then you buy the cryptocurrencies with the stable coin. And then if you want to get out of the cryptocurrencies, it's just an easier process for that currency to be turned back into a stable coin. As I mentioned, stable coins actually live in the same networks that cryptocurrencies do. So for you to get a wire transfer sent as a result of selling cryptocurrencies, that's a lot harder than turning your Bitcoin into a stable coin. And maybe you leave it there, maybe you then cash out later, but it's just an easier process. As I mentioned, Finality, their building actually is a stable coin. So it's a way of buying and selling securities in a way that's efficient. DeFi, I won't get into DeFi, but decentralized finance is financial services, loans, other markets, et cetera, but that aren't using banks. And so some of the liquidity and the settlement actually come through stable coins. And I know there's a lot here, so I'm not expecting everybody's going to be an expert, but just give you a sense of what these stable coins are used for. Cross-border, if I have a stable coin and I wanted to give it to any one of you, it's a very simple process. Literally, I send a message into the manager of the stablecoin network, and they can change the owner of the address from me to you. So it's very straightforward. Some gain exposure to US dollars because most of these are dollar denominated, so they'll stay on par with dollars. And there's very limited adoption in the retail space. These are usually more wholesale orientated, but it actually could be used in the retail space if someone wanted to start to go down that path, but it's not really going there at this point. And so that's sort of the major use cases for stable coins. If you want to go to the next slide. Another important recent development, a fairly recent development, was an OCC interpretation. This was not a new regulation, but interpretation, which basically said, there's two different interpretations. One says that banks can hold a hosted wallet stablecoin for a customer. So the way you define who owns a stablecoin, just like with cryptocurrency, is you get a private key. You get a key that you keep secret. But for safekeeping, you can give that key to your bank, and they will basically hold that for you in custody. So the first thing the OCC said was that banks could hold the private keys of their customers if the customers want it in safekeeping. So that was the first. The second, more profound, says that banks can actually operate on a stablecoin network. They could be part of the network itself, like actually run the system, or they could buy stable coins themselves and use them as interbank settlement with other banks or with their own customers. And so the INDN is a generic term for independent node verification network. So that just says that the network is not run by a bank or not run by any institution. It's an independent network that sort of runs by democracy, if you will, just like Bitcoin. And so banks, with these two interpretation, banks could actually build a stablecoin network or be an operator of a stablecoin network or buy and sell or settle with stablecoins. The caveat is you need to understand your risk and manage your risk, as they always say. So that's the hard bit. So next slide. So some of the risks, and there are many. The reserve risk, I mentioned these could be different types of assets. So depending on the asset, it may not, some assets are more liquid than others. So it could be, you could actually get a run on a stable coin for whatever reason that people are worried about it, just like a bank run, and they try to liquidate and get their US dollars out, and these assets just say aren't very liquid, then it could run into issues. Very similar to money market mutual funds that ran into problems. They were very liquid assets, but people started running from them in 07, 08, and even in the beginning of the pandemic, such that they had to sell those assets at fire sale prices. They could get the money, but they couldn't get it fast enough at full value. So that's one of the reserve risks. And this actually happened, recently to a stable coin, which I'll talk about a little bit later. And then there's a risk because if it's not audited. There's one in particular called Tether that's been getting a lot of bad press lately because they've never done a full accounting for what's in their reserve. They were found to have actually loaned a subsidiary of themselves money out of their reserve. I think it was a $500 million loan, which means that was a payable versus an asset, a liquid asset. And then there's also been changes of what's in the reserve, and they haven't been open and honest about what's in the reserve. They go from one type of asset to another and don't disclose that. So that's really creating some risks and some challenges for the stable coins because of some of the actors that work this way. If it's not fiat backed, like I said, stable coins are backed by contracts or other coins. They can have periods of fluctuation. There was one recently, I think it was Iron Finance was the name of it, and it had a combination of very stable assets in cryptocurrencies. And the way the smart contract worked, like I said, that's just logic. It had an error. And what happened was when people started to take their money out of that particular stable coin, Iron Finance, the smart contracts started buying and selling in a way that actually exacerbated the problem. And it dropped in value, I think, down to 78 cents instead of getting pegged to the dollar. It was a combination of not great assets and a smart contract problem. So these are complicated things. So it's really important to understand what's back there. Regulatory uncertainty. It was recently found out that Tether is backed 50% by commercial paper. And so obviously that's not illiquid, but it's not as liquid as treasuries. And so besides the financial risk, many people said that looks a lot more like a mutual fund, an unregulated mutual fund. Because what happened was it's buying securities. It's going to make money on that commercial paper because it comes with, interest or payback. And the money it made on that commercial paper it was holding went back to the coin holders, which is a mutual fund. And so there's been a lot of talk in Congress. My own president, Eric Rosengren, recently argued that it's an unregulated mutual fund. So once again, if you're a bank and the OCC says you can run these and hold them, you have to understand the regulatory risk because of the uncertainty. Systemic risk, if, for instance, the finality network got really, really, really big, it could be systemically important if the largest banks in the world are using it as the settlement for securities. Because if there's a problem, that means the securities trades are going to start to have issues. So this is my personal view. I think it's a really interesting network. It's being, designed well, et cetera, but it could create, systemic risk. And then blockchain itself has risk. Smart contracts. I said that there could be bugs in the smart contract. And there's a lot more here that gets too technical to get deeply into. So I'll just leave it at that. So a lot of potential benefits, but a lot of potential risks as well. If you go to the next slide, this shows you some of the sense of the growth. Really, just in the last 2 years, you can see from maybe 8 billion deposited to about 100 billion deposited. Most of it in USDT, which is Tether, and USDC, which is created by a Boston company called Circle. That's the C. And those are the two, major stable coins out there as well. If you go to the next slide, we just see a little more detail numerically. Now, this slide is about a month old. Because of some of the issues with Tether and the questions about what's in this reserve, it's now dropped to 62 billion. USDC is up to 27 billion. Beyonce's is 11. So you can see there's some movement between these. And so part of the challenge you have when you've got something that is a privately issued coin of any type is that it can lose its peg to the dollar or not trade at par. One of the greatest examples is in the States in the late 19th century, banks issued their own paper currencies. Municipalities, cities issued currencies. And it got to the point where if you were in Boston and you had a $20 note from a bank in Chicago, it wouldn't trade at $20. If someone took it, they may give you 19 because there's a risk that was fraudulent or they wouldn't be able to actually then further spend that money. So the same analogy could hold for stable coins or central bank digital or cryptocurrencies, that because of potential risk and potential for volatility of the money, they don't trade at par. So that does create risk in the market. And I'm sure you're all financial people, you understand the potential risks there. If you go to the next slide, I'll talk just for a moment on this and open it up for other questions. Now, one of the challenges with all of this, and the next slide has a bit more, but one of the challenges with all of this is you all know that there is no single silo. Things don't happen in a vacuum in financial services or in financial markets. Now, there's no payment system that operates in and of itself and doesn't have influence on others. It isn't influenced by other things. So you think of, it's called systems thinking. When you think about the whole system around any of these products, and if you think of financial services broadly, it's not even just one system. It's more like a universe where you've got galaxies made up of solar systems. So it's really systems that interconnect with other systems. When you think about even the traditional, the banking system, the securities, financial market utilities, and then take things like private currencies, stable coins, distributed finance, all of these, even big techs, if you see what Facebook and Amazon and others are starting to do, Google, these are all interconnected. And so when you look at all that's going on and then take what's here, which I've mentioned most of, but Facebook, what is Facebook going to do to all of our jobs? JPM coin was launched last year. It's an interbank international coin for JPM customers only, but that's a lot of customers. Cryptos, El Salvador designated Bitcoin as legal tender. I'm not even sure why, maybe because it's more stable than their own, but no one's ever done that before. That's just an interesting development. Securitization of assets. And I mentioned all of the regulation around potential congressional actions, both in cryptocurrency, stable coins. You may have seen today's Wall Street Journal said that Chair Yellen is convening a group of senior regulatory bodies next week to figure out what do we do about stable coins. So that's obviously significant activities. And also digital identity. Obviously it's connected to more things than just crypto, but my own personal opinion is in the States, identity is broken and we do not have a good solution for a national identity, digital, be it for financial services or others. So Congress is looking at that along with many of these other activities. And as I say, nothing against any of them, but laws are very blunt instruments. And so you often would get something that may not have been the same as if you spent years thinking about it, trying to resolve, working with the industry, which is what the Fed is doing our public consultation for, is to get engaged. And then DeFi is growing dramatically. And like I said, not to talk about that specifically. So I'll stop there and just, that's the slide deck. Stop there. We can move to questions. Bridget, if you've got questions, or if I'll go wherever the audience wants to go. It doesn't have to stay with the deck.
Great. Boy, that was great. You covered an incredible amount of ground in a very short period.
There's a lot to cover for sure.
Yeah, but we got some questions, so I'll try to sort of group them. One or two go to the central bank digital currency discussion. And I guess two questions there. One, and you alluded to this, but maybe a little bit more around how closely you're working with other central banks in exploring the benefits of and risks, et cetera, of the central bank digital currency. And then the second question you sort of talked about, there's two approaches. One would be to use the banking system if a CBDC is issued. The other would be sort of a direct to public. Maybe if you could talk a little bit more about that. Those are our two major CBDC questions.
Sure. Yeah, there's extensive cooperation going on around the world with central banks. Just through grassroots, we started meeting twice a year with the leading central banks when we're doing our project with Singapore and Canada and the UK. So we literally get 12, 15 central banks together to share experiments. Now through the Bank for International Settlement, there's a lot of work going on. The Fed system, and 6 other central banks wrote a paper. If you want to see one of the better papers, I think, on the BIS site, I believe it's either September or October. It's called The Case for Central Bank Digital Currency. It talks about the potential good, the risks, and some of the challenges of a CBDC. So it's a number of central banks contributed to that. And then those same banks are going deeper into certain topics, like how do you think about distribution? How do you think about privacy? What are some potential monetary policy implications? What's the implications potentially for financial systems? So a lot of work is going on. And then there's a lot of bilateral work where we'll be doing experiments, I believe, with other banks. So for instance, we're talking to Canada about doing work in privacy by sharing technology experiments and with the Bank of Japan. So extensive work. And then the innovation hubs, another way that central banks are working through particular focus groups to look at this. So very extensive. And we all don't have the same opinions, nor necessarily use the same technology. So all the better reason for us to be together is to make sure we're sharing and understanding from each other. As I said, our work will be created an open source license for the code. So we hope other central banks look at it. And as far as distribution models, first, nothing's been decided, because that's part of the consultation, is to understand what's different possibly. What we're doing in the system we're building it to handle any outcome. So any way of distribution our system can handle. So it could go through banks. The Fed could give the banks a certain amount of CBDC, like they have cash today, and they give it to their customers when their customers want to, or they're the conduit. Maybe they give them the wallet, and the bank is the intermediary that gives us the transactions, much like payments work today. But also could be other intermediaries. So one of the things I've been beating my head against the wall, failing miserably, is financial inclusion, trying to help the unbanked. And it's not homogeneous. And I understand it's not a simple answer, but could there be another intermediary that would work with the unbanked? Maybe it's a nonprofit or a public-private partnership. So you can think of different models. Most central banks are saying that the direct model, as it's called, where we have customers that are citizens, does not have a high probability of being the outcome. Or it could be a hybrid where it's banks plus someone else in together, being those intermediaries. So it's not solved yet, but we have to build it such that we can handle those models. And that's where the innovation can come. That's where I can easily see someone innovating, even a bank, making it more efficient, effective, or profitable to have what were unbanked before just use CBDC, and they're the wallet. So you're muted, Bridget.
It would be like, now how banks offer basic banking accounts, that could sort of be CBDC basic banking accounts, or other ways in that sort of hybrid model. Yeah, that's really interesting. So, and another, you listed a whole set of considerations, right? Monetary policy, privacy, um, AML, CFT compliance. What do you find, and I know this is your opinion, but what do you think are probably the most challenging of that list? The hardest
Yeah.
nut to crack.
Yeah, so I think there's a few that rise to the top. So I think privacy versus traceability for CTF, et cetera. I think those are hard. I mean, banks hate having to, do AML. I heard a figure, there's 20,000 people working on AML in the States. So that's a challenge even today. So I really think, so I have a saying, if you've been to Boston, you've seen how crazy our streets are. And there's a saying in Boston, don't pave cow paths. If you pave the cow path, you get Boston streets. So I think we have a chance to not pave the cow paths by building this central bank digital currency and possibly doing AML differently. So some of that is how do you use technology to think of new ways of catching the bad guys, so you can relieve some of the pressure here. Offline, you have to be able to process offline, because it has to be equal in functionality and usability to paper currency. And offline is not simple. It's not doing it is hard. It is hard, but also how do you then reconcile when you come back online? I'm sure everybody knows the challenge with ATMs. If you go offline, you have risks, but you do things like limit the dollar amount, et cetera. And so there are things that you can do there. I think building a system which allows for innovation, I think, is a challenge, because every decision you make, you may limit possibilities later. And I'd say another one is the distribution model, how to get it right without creating unintended consequences. And part of that means, flight of bank deposits, or disintermediation of banks in some way, or sub-optimizing what a central bank digital currency can do. The distribution model could also limit its effectiveness. So I think those are the ones that rise to the top. but there are a million little ones. I'll give you one quick example. We started with the assumption that the order of the transactions had to be maintained. So every transaction that came in had to be processed in order. And we said, why? That's not how currency works. And so we've got a couple of different models we're working with MIT. One, we keep the order, and one we don't. And when you don't, you can scale dramatically because you can run in parallel if you don't have to keep the order. So something as simple as that question, do you have to keep the order or not, has profound implications, as do everything I listed there and more. How about, we think a CBDC can actually be used in the future for micropayments, which can't be done effectively or efficiently today, or the Internet of Things. Maybe finally my refrigerator can order and pay for my beer in a way that is effective. So that's why when we think of scaling, we think of scaling for 20 years from now when we're talking about dramatically more transactions.
Yeah, that's it's really exciting. I mean, it's sort of like Jeff Bezos launching into space today. You're like our
trying hard.
Future. I mean,
but like Bezos, I don't want to blow anything up.
Yeah, understood. And you probably aren't getting paid quite as much either, but
no, and there's no IPO here at the Fed either.
Yeah, exactly. Couple questions here on Bitcoin. So first, stablecoin versus Bitcoin. Is stablecoin Bitcoin? Is it like Bitcoin in the sense of, and the specific question is, how Bitcoin, and a lot of attention around this recently, the climate demand. It's a very climate unfriendly product. Are there any of those concerns for central bank digital currency or stable coins?
No, none whatsoever. The reason, well, stable coins maybe some, but definitely not for central bank digital currencies. It's a bit complicated, but the way Bitcoin works is it's an untrusted network. Like there's no central bank, there's no company, there's no one backs it. And so to get rid of some of the challenges and risks, that the people that maintain the network have to do something called proof of work. And proof of work is how you validate and then make sure all of the copies of the data are in sync. It's a whole session in and of itself, but they do something called proof of work, which is the algorithm for doing it. Extensive energy consumption. A bank is trusted. I mean, a central bank is trusted. So we would do our own validation. We wouldn't have to use that really intense process for validating transactions. The way we do it would be the same as a regular payment. No more energy than a regular payment. And the stable coins, if they use those methods today, are trying to move to efficient ones. So definitely not for central bank digital currency. And others are trying to move away from those today.
To the extent that there's movement towards central bank digital currencies, do you view those as competing with or diminishing the need for stable coins? Is a question.
Well, I think, yeah, so any new payment is going to compete with everything else. So debit competes with credit, which competes with ACH, which competes with cash, which will compete with FedNow and other faster payment schemes. There's always some competition. The work we're working on with our CBDC is retail focused. So I don't think there'll be much competition necessarily with stable coins because they're really not used for retail. Most stable coins are used for either wholesale or they're used to buy and sell cryptocurrencies. So by definition, you would have, it's a different market. There could be some competition there. Some say would wipe out many of them. I don't think that's the case. Most people buy Bitcoin for speculation, not to use as a payment. And the same with stable coins. There's usually different use cases there, but there's definitely some potential for some competition.
Great. We have a question about the legal framework for digital payments, and the specific is for what would the legal framework be for digital payments for like a trade transaction if parties need to undo or resolve it? How does that work?
Yeah, so for any trade, obviously, some is built off regulation, but generally it's contractual.
Right,
It's whatever the terms of the contract are will demand what monies move when, what liabilities shift when, who has ownership when. And so I don't think the framework for the payment would have much specific implications for trade because it's usually the terms are done bilaterally. But you would have to think about like a wire transfer in the US is final and irrevocable, which means when the money moves, you don't get it back. You have to go through the courts. And that's the one thing I can think about that I don't know what I'm not sure what the policies and regs will be for CBDC. Is it
mhm,
final and irrevocable, or can you get it back if someone steals it or whatever else? You can always go through the courts, but that's a separate question. So I don't know what the answer to that is, but I'd say it really depends on the regulatory framework, which right now in the US is not defined. I've heard different things. I've heard people say, like cash, when it moves, it should move. It should be final. If you lose it, you lose it. Others say, well, it's digital. We have the ability now to find it and to get it back. So it depends how you build it, and it depends what the rules of the road are. So nothing definitive, but that's part of the consultation too, is how would you like this money to act? Is it final and irrevocable, or can I get it if it's stolen? So open questions, but
um,
important.
last, last question that came in is if the Fed decides to move forward with the central bank digital currency, is any congressional authorization or legislation needed? Or is this something that the system has the authority to do now?
Uh, it's always good when you quote your chairman. So I'll quote Chair Powell, and basically he said, even if we had the authority, it's important that we have the backing of Congress. This is too important to do without, so he would rather, at least in his words, say he'd rather Congress explicitly create legislation that tells us we can do it so it's not ambiguous. There is questions about, is it legal tender? They didn't envision this back in 1913 when they wrote the Federal Reserve Act, and it does say paper, I believe. We do paper in the coins are done by the mint, so it's even that's different. So we believe we should have congressional support, and there may actually be cases where we have to have legislation.
Great. Well, Jim, this was just fantastic. You've done, and there's been an incredible amount of work done, an incredible amount to do. To the extent that the IIB and its members can be helpful, please, we're here, and we will be watching and participating in the discussion as you all move forward. Good luck and Godspeed.
Well, thanks. I appreciate the invitation. And really, my job besides running the project is to both educate, evangelize, and not assume I know everything and seek input. So you've got a very important constituency. So I'm willing to come back and talk after the paper's written and stuff like that. Or I literally mean if there are questions from your folks that work through you, Bridget and Megan, feel free to pass questions along, or if even something comes to your mind. I'm here to, like I said, to be part of the network that keeps the universe together.
Well, that's really fantastic. We welcome that, and rest assured, we'll be taking you up on it.
All right,
So
thanks, Bridget.
thank you. And everyone, we're going to take a very brief break. Word from our diamond sponsor, Davis Polk, before we turn to our first panel, business opportunities for digital currencies for financial institutions.
Hi, Rob. Good morning. Oh, hi, Karim and Luke.
Hi, good morning. Can you hear me?
Yes, I can.
Great.
Hey guys, can you hear me?
I can, Luke. Yes, thanks.
Good morning. Can you hear
Karim.
me?
I can. Thanks, Karim. Yeah.
Great. And just a warning, we're live, so. I mean, but the panel hasn't started yet, but we're.
Just let us know, Bridget, when you'd like us to get going.
About 10 seconds. Great. Welcome back, everyone. That was a great first session. Jim Kuna really covered a lot of ground. But now I'm pleased to introduce our next panel to talk about the business opportunities of digital currencies. Tim Davis, a principal in Deloitte's Risk and Financial Advisory practice, will moderate and will be joined by Karim Hamazni, Director of Crypto Asset Innovation at RBC Global Asset Management, Luke Dorney, Head of Sales and Partnerships at Zodia, and Rob Catanello, Co-CEO of B2C2. Tim, I'll turn it over to you. And I just want to remind people, please continue to submit questions. Really appreciate all the great questions we got on panel one. So Tim, that's all yours.
Super. Thank you, Bridget. And I think we have a fantastic panel this morning. So it's a pleasure to be with you all this morning. What I'm going to do is just ask each of our panelists to just go in order. We'll go Karim, Luke, and then Rob. If they could just introduce themselves. And in your introduction, if you could just say a little bit about what your own institution is currently doing with digital assets, and that would sort of set some context, I think, for the discussion that we're about to have. So, Karim.
Great, thanks for having me. I'm really excited to be here. So yeah, my name is Karim, and I lead the crypto asset innovation team here in RBC Global Asset Management. So we're mostly an innovation technology team that lives in a sandbox, and we get to experiment with this incredible technology that is crypto assets, trying to uncover emerging potential business opportunities, understanding the risks in crypto assets, and seeing where they could fit into the future of finance. Currently at RBC, we don't offer any products in crypto assets. We have been looking at this space for several years now and trying to quantify the risks and trying to overcome them and understand what makes sense if we are to enter this space. But we're going to take a pretty prudent approach for the time being, and we might offer some products or services if and when we feel that the risks can be mitigated and that it makes sense for our clients and our shareholders.
Yep. Hey everyone, I'm Luke Dorney. I'm head of sales and business development for Zodia. And Zodia is a crypto custodian that's just about to launch here in the UK. We are co-owned by Standard Chartered and Northern Trust. And this is a project which is a result of 3 years of analysing the crypto asset markets and understanding through our innovation arm at Standard Chartered where we can offer services and take the first step into the crypto market. You know, we're a crypto custodian that is leveraging the existing infrastructures at Standard Chartered in terms of asset safety principles and making sure that we have built our own crypto asset infrastructure to service institutional clients around the globe. And we're just at the start of that launch. We're literally just about to launch in a few weeks' time. So exciting times for us.
Hello, everyone. My name is Rob Catanello. I am co-CEO of B2C2. We are a true principal at risk liquidity provider in the crypto space. We are not an exchange. We are not an agency broker. Our business model is very, which should be familiar to people in traditional finance, as we act in the similar way that a bank would act in FX, e-commerce, or U.S. government securities. We started out market making on exchanges, and we have grown to become the preeminent provider of liquidity to people over-the-counter clients. and we're still probably top 3 or 4 liquidity provider to exchanges. We believe that by increasing the amount of other liquidity providers similar to ourselves, we'll be able to help price transparency and just get a lot more trust in the market. Our clients range from high net wealth individuals, family offices, to hedge funds, traditional finance firms that are now starting to trade in crypto. And we really do consider ourselves to be the backbone of liquidity provision in the space. Thank you.
Okay. Thanks, Rob. Maybe let's just start the conversation. I mean, there's many ways we could go with where are the business opportunities for financial institutions, but let's start with custody, because custody is somewhat of a sort of a foundational offering. And maybe, Luke, if I could have you just start and then have our other panelists join in the conversation. But really, just thinking about custody, what are some of the key things you think the audience needs to appreciate about how custody is different than regular custody?
Yeah, sure. And I think this has probably been the educational process that we've been through over the last 3 years in really kind of trying to understand truly what crypto custody entails. So if you think about a digital asset as a bearer asset, and you can change ownership of that asset on a public or private blockchain, and ownership of that asset is determined by possession of a private key, and that private key holds the key to the wallet that is holding the crypto assets on chain. So ensuring that your private key is safe and secure away from any bad actors is essentially the point around crypto custody. So as a crypto custodian, the main things that we think about are, generating and securing that private key for our customers. And once that private key is secure, actually providing connectivity to blockchains in order to move your assets on chain. And facilitating that receipt and delivery of crypto assets in a regulatory and compliant manner for institutions is something that is a little bit different to moving your assets from one CSD to another for traditional assets, right? So ensuring that you're building the right ecosystem and working with the right reputable crypto market participants. And what I mean by that is trading venues, brokers, other custodians, and ensuring that you recognize the beneficiary and the remitter of every transaction that you're facilitating through the crypto through the blockchains and essentially through the crypto ecosystem. So those are kind of the four things that we think about as being a crypto custodian, and then we can go into detail as to how you actually achieve that. But yeah, they're the main things we think about.
Yeah, I think as you alluded to, I mean, what's unique about the private key material that the custodian is keeping safe is it actually doesn't even need to be stolen. It just needs to be viewed. And in being viewed, essentially at that point, all of the underlying assets underneath that private key could essentially be lost. And in a decentralized network, there's nothing you can reliably do that would prevent that. And so in that sense, I guess there's a unique risk. The other risk that I know sort of banks are very conscious of relative to other institutions in this space that are not regulated in the same way is, whether or not if you're offering a custodial service, you are effectively a full backstop for those. If you had an unregulated institution somehow mismanage its custody and go under, then it's, well, too bad, that money's gone. But in the case of a bank, possibly not so, and possibly, quite possibly the bank might want to, either for reputation or legal reasons, actually be a full backstop. And, so I don't know if that's something that, Luke or Karim, in terms of how you think about sort of the risks that you've thought about.
Yeah, I can step in a little bit. And that is certainly one of the biggest challenges and risks when it comes to private key management, holding on to crypto assets. I think what Luke and team are doing over there is pretty interesting and kind of amazing. They built a system that leverages cold storage and air-gapped solutions, and also hardware security modules, which really secure private keys to prevent any kind of hacking. I think banks are well positioned in a situation like this because we have certificate authorities and we have infrastructure and we handle private keys for other parts of the bank elsewhere. And to adapt that to crypto is not completely foreign to us. The stakes can be a bit higher. And so we do have to start looking at some more unique structures and start to look at some insurance products as well to help cover us in case something terrible goes wrong.
And I think the point there is you know, it's not necessarily easy to build this inside a bank's existing technology infrastructure, right? So one of the key things that we focused on was, you know, in order to be competitive in this market and ensure that we are you know, mitigating the right risks, is building our own technology stack. You know, we're a subsidiary of the bank, but we don't necessarily utilize the existing technology frameworks for traditional assets, and we've kind of, you know, built that from scratch. So, you know, one of the key items I would say for banks looking at setting up businesses is you know, do you have the right technology risks identified, and can you build that yourself or can you outsource? And really kind of trying to tie that up with the fraud and compliance risks and building a product around it. But it all starts with the technology, and that's the important part.
Yeah. And I think, as you're saying, Luke, I mean, many of the risks are unique. And so the existing risk management systems and processes at banks may not actually be well suited to managing these unique risks. Obviously, there's an aspect of risk that relates to the types of digital currencies that you're offering custody for. How has Zodia sort of thought about that in terms of which digital currencies you'd be willing to custody?
Yeah, so I mean, it's a very important part of our offering in terms of understanding the principal risk types of each crypto asset. And the way that we operate this is that we go through a crypto asset framework. So we try to understand the underlying reason for that particular coin, the reputational risks around that coin, the blockchain that supports and the protocol that supports that coin, and the liquidity around that coin. So various different aspects, and we go through that crypto asset framework assessment as a firm across our compliance, risk, technology, business development partners, and really trying to understand whether or not we want to offer services in that coin. And really that's, you know, a two-pronged approach there is, from our perspective, are we comfortable with the risks? And from our client's perspective, you know, do they want a service provider that, you know, services multiple coins that they don't necessarily understand the risks associated with that? So that is a very important process for us. And really what that culminates in is that we're going to be a custodian that won't be everything to everyone, right? So we will be a crypto custodian for Bitcoin and ETH to start with, make sure we're comfortable with of how to build a business around that. And once we're comfortable and we see liquidity in other coins from an institutional perspective and we understand the risks, then we'll move through our crypto asset frameworks into other coins. But it's going to be a very cautious approach as we continue the launch.
Karim, anything you'd add in terms of how you think about risks associated with different types of cryptocurrencies?
Yeah, certainly. There are different blockchains that are more battle tested than others. Bitcoin's been around for so long, it's battle tested, and you can reasonably assume that it's going to continue to work as designed. But then there are other blockchains which have some significant value backing them, but they are more susceptible to on-chain hacks and whatnot. So you really do have to evaluate which blockchains you want to support, which crypto assets you want to support, because there could be some network vulnerabilities in the assets that you pick that could have some substantial impact to the assets that you have under custody. There are 51% attacks that have happened on popular blockchains like Ethereum Classic, and so on. And with that, there could be some substantial material loss for the clients that hold onto those assets. So you really need to take a technical lens and evaluate the assets that you want to look at. And a framework similar to what Luke said they employ over at Zodia is exactly what you need to protect from those kinds of situations and events.
Rob, which cryptocurrencies do you facilitate? And can you talk a little bit about kind of why and how you think about that?
Sure. So the number one decision factor for us when adding a new coin really is the size of the float. In addition, once we're comfortable with the underlying blockchain itself, and the reason is because we do offer 24/7 trading and settlement. So we need the ability to borrow in order to maintain these effective sort of pricing strategies that we run and to be able to settle on demand with clients. So not unlike what you're hearing from my colleagues on the call here, we are not all things to all people. So we only offer roughly 11 or 12 coins. Obviously the big ones, Bitcoin, ETH, Litecoin. We do not offer Ethereum Classic. We only offer two stable coins, Tether and Circle. We also offer EOS, Polkadot for non-US persons. We actually started trading Polkadot for US persons. So let me take that back. Chainlink, Stellar, Uni, and BNB for select jurisdictions. We need to make sure that that the underlying blockchain is secure, and that's why we really don't trade Ethereum Classic. It was brought up before with clients, and at the same time, it's really important for us, like I said, to be able to access the necessary liquidity so that we can show consistent pricing. Now, on May 19th, for example, when everyone else stopped pricing, all the exchanges pretty much had a pause. Lots, if not all, of the agency brokers involved in the space also paused. We never stopped pricing. Our spread stayed very tight, and we did over 725 individual settlements on that day. So that's basically one every 2 minutes. Had we gone with some of the more esoteric coins, we may not have been able to, to settle. And it's very important for us as that is our compact with our clients. So we really take it very, very seriously, and we have no plans to greatly increase the number of coins we trade. But we are increasing the number of fiat currencies that we trade against with these coins.
And Rob, when it comes to custody, how do you think about that? Do you use a third-party custodian?
So we had historically done, cold storage with one of these, right? Or several of these, but these things get lost all the time. So we really support our clients using bona fide custodians. Here at B2C2, unlike, again, most, if not everyone else, our KYC applies to the wallets of our clients. So we do not accept funds from, nor will we accept or will we send funds to third-party or exchange wallets. This allows us, along with our other system enhancements, to meet the travel rule. But we do accept bona fide custody solutions, and we really do recommend that our clients, look at some sort of of custody solution, just because we've all heard the stories where people lose they lose they lose the dongle, or they get hacked, etc. We use one. We don't use anyone for custody. We do use one provider for a shared wallet solution. And what's important for us is that our global operations team can access the wallets of any of our legal entities 24 hours a day, 7 days a week. And we can, and we have the ability to do the large number of settlements that is required from our client base.
Yeah, and I think you're touching on sort of, I guess, a key trade-off there, which is access versus security, right? I mean, on the one end of the spectrum, you've got everything offline and cold storage, and then you have to sort of take some sort of acceptable level of risk to have a high level of access, right, to those funds.
Correct. And there are a couple solutions out there that are very secure, and we continue to talk to new people because we're always looking to up our game. But we certainly encourage everyone to, to take as much care as they possibly can with their assets. And really, from a regulatory point of view, I think it's just a matter of time. Like lots of people were very upset about the proposed Mnuchin rule, but really that shouldn't be a big deal, right? You should know where the coins coming into your wallets are coming from and to whom you're sending them. So we would actually encourage increased regulation along those lines.
Yeah. So and we have a few questions coming in, and we'll get to those in a moment. But if you have questions, please use the Q&A, and we'll try and make this as interactive as we can. So just as we're sort of talking about risks that, we've touched on some of them associated with custody. We talked about the technical stability of the coin and choosing which coins you're going to serve. We've talked a little bit about storage. We will get to, I think there's a bigger conversation we need to have around regulation. But some other risks just to touch on. I mean, one is obviously whether or not the coin might be considered a security by securities regulators. And that, I think, is another consideration. The other one, in terms of just technical risks, might be forks, right? So if you were to have, and there've been numerous forks, Bitcoin Cash, Litecoin, et cetera, all forks off the Bitcoin blockchain. But in the context of accommodating a crypto custody solution, you have to have some process to kind of anticipate how you might handle a fork. And I don't know, Luke, if your thinking has evolved on that, if you want to share how you would think about how you might handle a fork if that were to happen.
Yeah, sure. And I think the key here on the forks is that you don't necessarily know what, up front, you don't know what that fork is potentially going to entail. You don't know when that fork will be triggered. So it's very, very hard to say right from the start, yes, we will support that fork, right? There's many factors that need to be considered as part of the review. So our default position as a custodian is we will review and monitor the market developments around forks. We will try to make decisions as early as possible with our clients in mind and understand whether or not that fork can be supported. And that, when I mean supported, that means is, do we have the right technologies to support that new fork? Where is the liquidity going to sit? Is it going to be on the new fork or on the existing chain? And also that also applies to airdrops as well. So if you're randomly receiving airdrops, they're not necessarily a covered crypto asset under our legal agreement straight away, because again, we don't know exactly the details of what that airdrop might entail. So there is an element of a case-by-case basis of that review. But I think, clients entering that space, they realize that especially the institutional clients, they realize that a very prudent approach to reviewing airdrops and forks and understanding the risks associated with that without, upfront saying, yes, we're going to support everything, because we don't understand the risks. So it's reviewed on a case-by-case basis.
One of our panelists has asked, can we explain what a fork is? So I can just give a sort of a quick so essentially, cryptocurrencies are decentralized networks that operate on a basis of consensus as to what the rules are that is going to govern that particular blockchain. Most of the popular blockchains have change proposals, like Bitcoin has the Bitcoin improvement proposal process. A similar process exists for Ethereum. It's quite possible from time to time that there is a split in consensus as to how the chain should be managed. And so at any time, anyone can introduce a new set of code as a new proposal, essentially, for how the blockchain should be managed. And any of the participating nodes can choose to facilitate that alternate way of operating. And essentially what that does is that creates a new blockchain system. And that is what is a fork. It takes transactions up to a certain point in the chain, and then from that block forward, it will essentially just start processing transactions under those new set of rules. And this is how many of the forks like Litecoin, Bitcoin Cash have been created as forks of the Bitcoin blockchain. And so there's no controlling, as Luke alluded to, there's no controlling as to when forks may occur. It's just the community may reach a decision that they don't have full consensus as to a potential change.
There's also no consensus or guarantee which transactions and which chain the miners will support. So that's why you get these different coins, right? There's a pretty big Ethereum fork that is looming. And, you know, if you can't entice the miners to actually mine the transactions, and you do so by paying them in the coins, you know, that could have serious network effects, you know, on the chain and speed effects and things like that. So it can get to be very complicated. And I know from our perspective, with the last blockchain, part of the Bitcoin Cash fork that happened a little while ago, we told clients that we weren't going to support the fork, and if they left any Bitcoin Cash, you know, in their wallets here at B2C2 over the fork, we weren't going to give them the new token, et cetera, et cetera. So there's a lot. I think communication is the most, from our perspective, in addition to making sure our accounting and risk systems can handle the new blockchain, communication with our clients as to what we will and won't support is paramount in situations such as these.
Yeah, super. Thank you, Rob. So custody is one of the sort of base services. One of the others that financial institutions obviously can consider, in addition to or as an alternative to custody, would be payments. We had a question, you know, what types of payment services are banks looking at regarding cryptocurrencies? So do any of you want to sort of take on what you're seeing out there relative to what types of payment services banks are thinking about? Maybe
I can a little bit on that. So when you look at a cryptocurrency like Bitcoin, it's actually very difficult to see it as an effective payment currency. And so for the most part, and I do think this in banks, for banks in general, not just RBC, is that we see crypto assets more as an investable asset class, an emerging asset class, and less so as a payment medium. That's not to say that it won't be. We are seeing some announcements from major players like Visa and MasterCard who want to put cryptocurrencies on their rails and give that as another option for payments. But for the most part, because of the volatility in price and so on, and the slowness of the blockchain itself, we don't necessarily see it as an effective payment medium. But that could change. And, you know, we're starting to see that change more and more with the advent of stable coins on faster blockchains like Ethereum. And when Ethereum catches up in scalability and can support more transactions per second, stable coins may be an effective payment medium. But then we're also bound by regulatory uncertainty when it comes to stable coins and how they can be supported as a means of payment. And so there's a wait and see approach to how stablecoin regulation is going to materialize before I'd say most banks are going to put their weight behind that kind of technology.
Luke and Rob, what are you guys seeing relative to payments? Obviously, Rob, your business is sort of somewhat in the payments space, right?
Well, you know, we've actually had significant discussions with some corporations, and there's still a lot of you know, of questioning, you know, how exactly you could use any sort of crypto absent a stable coin for, you know, for payments. Like, for example, you know, some of the problems that early proponents of this run into is that by the time, just given the underlying volatility in the tokens, by the time, you know, I buy, let's say I want to pay for something, you know, with the token, I go and I acquire that token, and by the time I send it to the merchant, when it, you know, is the price fixed when I initiate the trade on the blockchain? Who decides what sort of fees I pay to get that transaction done, or do we have to wait for the coins to hit at, you know, to hit the merchant's wallet before we decide whether or not I actually paid for it. Did I pay too much? Did I pay too little? So I think a lot of traditional sort of corporates are looking to people to stand in the middle if they're accepting blockchain or something. So they'll go to a third-party provider and they'll say, listen, you can pay in Bitcoin. I don't ever want to touch the Bitcoin. The widget costs $10. You determine what to charge, and for every widget I sell, you handle all the crypto, and you just send me $10. Stable coins, are probably the best way to go, I think. But there, as was previously brought up, there are a lot of regulatory concerns with that. Some stable coins have questionable backing, it's financial backing, but something like half the world's population don't have access to the banking system. So you could see an argument as to why stable coins would work for individuals such as these, or even in developed countries there are people that just can't get credit cards for whatever reason, or don't have access to bank accounts, and increasingly it's hard. It's hard to pay cash for things. So I would imagine it's going to go that route, whether it's a central bank digital currency or some sort of an endorsed stable coin. I'm not sure, but I really think that that's the way it's going to have it. It's very hard to pay, for something in Bitcoin, just because of the speed of the blockchain, the way that the volatility and fees to move things along. It's kind of like a knot that you just keep unraveling and unraveling. And I just don't see a very practical solution.
Yeah. Go ahead, Luke.
Yeah, I was just going to say, I think that probably the most common use case that we see is cross-border payments, right? So the ability to transfer value cross-border on almost an instant basis, and that's difficult to do that, as Kareem and Rob said, with something like Bitcoin, where it's so volatile. So by the time that you've managed to source that Bitcoin and then move that to the counterparty that you need to, the value of that coin could have changed quite significantly. So stable coins are extremely important for that. Ripple would have been the obvious choice, but obviously with the kind of the regulatory scrutiny around that coin and whether that's classified as a security is challenging. But definitely stable coins are becoming more and more prominent in the conversations that we're having. But one of the other things I would say is, utilizing a stable coin for payment of a crypto transaction, right? So for post-trade settlement, so utilizing the stable coin as the fiat side of the transaction and being able to move that quickly, or potentially tokenizing a piece of collateral, which allows you to then utilize that as a payment mechanism, for example, or utilize that as collateral. So they're the type of use cases that we're seeing come up as part of the ecosystem.
Yeah, I think that it's also
for people to. It's very, it's very common for people to trade crypto versus, stable coins, Tether, USDC, for example, versus Bitcoin, Ethereum, you name it. It's very, very, very popular.
Yeah, one of the sort of, legal questions that still I think is unresolved is if you're paying with a stable coin, is the stable coin itself its own bearer instrument with its own intrinsic value as a piece of property that you're providing, or is it essentially a cryptographic IOU that's saying, I'm giving you this note, which is essentially the promise to kind of give you the underlying kind of fiat that it represents. And I don't think there's sort of a sufficient kind of legal precedent or regulation on that point. But it does lead us, I think, into this regulatory fragmentation, between jurisdictions. And I think we've got a number of different countries covered in, panelists in terms of where you do business. But just, can you talk a little bit about sort of how you're thinking about the differences in regulatory fragmentation, how you plan to manage that in your business, or how you do it today?
I can start with that maybe, and then you can move on to others. So as I said at the top of the call, that we are our home regulator is in the UK, so we are registered with the FCA. We recently just received our regulatory approval, which is great, and we're going to be registered as a virtual asset service provider under the anti-money laundering regulations in the UK. So that allows us to offer crypto services as an institution to institutional clients. That does not mean that we can then passport those services into other jurisdictions around the world as a crypto custodian. There are some jurisdictions that we can. So Switzerland, for example, we're allowed, we can operate in that jurisdiction without having additional crypto asset licenses. But somewhere like Germany, for example, where they have their own crypto regulatory frameworks, we can't just offer services to German clients sitting here in London. So across Europe, for sure, that is one of our focuses, but it's extremely fragmented. Now, MiCA, which comes into play in a couple of years' time, and the jury's out of when that might actually come into play, but that is the regulation that will supposedly harmonize Europe for crypto assets. So we've already registered with the Central Bank of Ireland to become for a crypto asset license in Ireland, and that will cover us hopefully for the harmonized jurisdiction across Europe. And I, from my understanding, there's still a lot of work to do there to harmonize Europe across crypto assets. And we're also quite prevalent in Asia, obviously with our background with Standard Chartered. Again, in some of those jurisdictions we need licenses, in others that we don't. So as you can see, as I'm talking through this, the fragmentation across the world is extremely difficult to manage. We have to get legal opinions in every single jurisdiction to understand whether or not we can market and then offer services in those jurisdictions without a crypto asset license. But there isn't a silver bullet to work this out globally. There is a lot of work that needs to happen to bring that all together.
Karim?
Yeah, speaking about regulation in Canada, I'll talk about it big picture. We'll first touch on custody. Canada is pretty advanced when it comes to crypto regulation. And so there are several ETFs that are now trading on the Toronto Stock Exchange with crypto assets. And what you see is that you'd have a trust company, in the case of almost all of the funds, they're employing a bank out of Alberta called Sidel Trust, which has a sub-custody arrangement with Gemini. And the regulators here have given that the stamp of approval. And so custody in that model is permitted as long as the primary bank has that trust license, and then they can sub-custody it out to a provider. When it comes to the exchanges in Canada, crypto assets that trade on exchange are considered a derivative and are subject to securities laws. And the logic behind that is, as you're trading on an exchange, you're not trading the actual Bitcoin, you're trading a right to a claim to Bitcoin in custody. And you don't exercise that right until you issue withdrawal on the exchange. So at the time of price discovery, you're just trading what are essentially IOUs, and those are seen as derivatives. And as such, exchanges in Canada and exchanges that service Canadians have to register with the securities regulators here, and they have to try to get membership into IROC, which is our self-regulatory organization in the securities world. So, and we're starting to see that the OSC is beating the drum and going after a number of exchanges. Binance was the latest one that made headlines. Poloniex, KuCoin, and you name it, who service Canadian clients, are now targets of regulation. But nonetheless, there's a lot more clarity. And a lot of the major exchanges that do service Canadian clients are now going through the right process to get the regulatory requirements. And so it's nice that we have that clarity. It is a little restrictive, but at least we have that clarity and there's a path forward. And that's a good thing. So that's where Canada is with regulation. At the bank, though, we still don't think there is enough clarity to necessarily participate in this space. And so there's still more of a wait and see approach to see not just how Canadian regulation plays out, but also US regulation in other jurisdictions that we may be exposed to.
Okay, super, Karim. Rob, anything to add?
Well, yeah. So our parent is also a UK entity, so B2C2 Limited. And we are in the VASP process, similar to what we were just talking about being completed. We have an FCA regulated sub that allows us to trade derivatives in crypto. We have we have a Cayman entity, again, where we're in the BAS process. In the US, you know, I mean, the US is a patchwork of regulations, you know, on a state by state basis. So there are states in which we don't trade. We believe that more and more states will move to a bit license, like a New York bit license model. And our application for that is pending. So, you know, we anticipate more regulation as opposed to less, and we are preparing for that, both through we're taking steps to become a broker dealer here in the United States, and also, you know, to even potentially become a SEF. You know, as we launch options, you know, we think there's going to be a tremendous amount of demand for that. We currently are offering Delta One derivatives, but we don't offer them to U.S. persons. The options would be offered to U.S. persons, and we're very sure we'll blow through the de minimis exemption in no time at all. So everything that we can do, and we've just actually had some new joiners whose job specifically is to, you know, get us a broker dealer license. You know, make sure we're fully compliant in terms of reporting for derivatives, et cetera. So we are. That's just in the U.S. Internationally, like I said, we've done all the right things in terms of applying for licenses, and we are also expanding the number of jurisdictions in which we want to operate. So we're in the process of setting up subsidiaries throughout Europe and the world. We started out with a very big customer franchise in Japan, where it was regulated. So we have a lot of experience, you know, in building systems, et cetera, to meet regulatory requirements, and we're just, you know, we're just following through with that. But clearly, it's going to be more regulation as opposed to less.
Yeah, the one regulation tour that we didn't talk about is, you know, the IRS in the US. I mean, and there is still, you know, an open question, and particularly with stable coins, it may not be a risk that most people appreciate, but to the extent that it's viewed as property, if you're selling property and receiving funds in receipt of that property, in theory, that could be a taxable event. So if you're receiving money and issuing a stable coin, if you're having to pay sales tax, you kind of destroy the entire model. So, you know, that's just another area where if, you know, you're in the stablecoin business, you want to get some tax advice. There's a question from the audience here on how are banks thinking about cryptocurrency in the context of mortgages and commercial loans? And I guess there's a couple of ways you could think about that. One is accepting crypto as a payment to, you know, in your mortgage, your customer's mortgage obligations. Or you could think about it in the context of the possibility of tokenization of assets, right? And the whole potential to securitize assets on the back of a blockchain. Do any of you have any perspective on that?
So I was going to say, to me, that feels a long way off. The conversations that we have with banks, and, you know, by the way, we're talking to pretty much all of the global banks at the moment to understand where they are in their review on crypto, whether that's them trading crypto for themselves on from a prop perspective, or whether offering prime services, or looking at offering services to their underlying clients. And it's clear to us that there aren't any banks out there really that have top-down approval to actually take Bitcoin onto their own balance sheet and to offer services. So yes, they're all looking at infrastructures to understand if and when they did get that approval, how they would actually implement an infrastructure. And I think the closest thing that I could say maybe mirrors that, or kind of answers that question, is, you know, banks are looking at ways in which to take Bitcoin as collateral to provide financing, or, you know, provide some other services with Bitcoin as collateral. But to me, that is not the first step in the chain. That is once you're comfortable with, setting up a crypto business, you can then start to be a little bit more adventurous. But to me, that feels a long, long way off.
Yeah, I would agree with that. I mean, we have actually facilitated the purchase of crypto for people who are buying homes or something with crypto, not in the U.S. Or Western Europe, but so we've seen that happen. We are actively working with some issuers on doing an on-chain commercial paper issuance, which I think is an important first step as well. But I think what you're talking about is is some years off, but I do think it will happen just because of I think the efficiencies afforded by blockchain technology in general, as opposed to any one coin. But I don't see it in the next 3 years, 5 maybe, but not 3. I don't think.
Yeah, and I would echo the exact same sentiment. Still several years away. We're seeing some of these new fintech players, such as BlockFi or Nexo.io, that are creating some interesting lending products around crypto assets. But even then, today, there's a massive headline that BlockFi had a cease and desist letter sent to them from the New Jersey regulators. So there's still so much regulatory uncertainty around lending products around crypto. And we still think that space needs to evolve more before it can be taken seriously.
Yeah, and it's an interesting case, Karim, that you brought up, because in that case, this was a product in which interest is being offered on a crypto deposit. And I think it was that mechanism of offering interest on a deposit that was viewed as being a security. So yeah, it just sort of highlights, I think, some of the regulatory risk in terms of, and how it can sort of manifest on a state-by-state level, let alone at a federal level in the US. We touched a little on Bitcoin as collateral. It's a couple of years away, maybe not as much of an urgent conversation, but obviously given the volatility of Bitcoin, anything that you have as collateral that's volatile introduces its own sort of challenges. In terms of, we see some of the financial institutions trying to avoid the complexities of custody by looking at NDF type products where they're not actually having to settle in the underlying commodity. So a non-delivery future. And some of the risks associated with that. I mean, obviously there's one risk, which is that you still have to have pricing integrity. You still have to have confidence in terms of how that future is going to close and at what price and how is that price being set. So I don't know if Rob or Luke or Karim, if you've had any exposure to that.
Right. So there does seem to be a big push in some circles toward the NDF because it would absolve someone from the requirement of actually handling crypto. The main concerns, and if people want to trade NDFs, we'll trade it with them. But the main concerns that we have is the fixing mechanism themselves come from exchanges, and by definition, they'll poll exchanges, et cetera. The problem there is that these exchanges are not principal at risk sort of taking or making entities. And it's very common in times of market volatility to see prices really blow out or simply disappear from exchanges. And so what happens to the NDF fix if there's a huge disruption in the market and Bitcoin drops or rallies 50%, which happens more than than once a year typically? What do we do then? There's so much uncertainty around it. And we warn all of our clients who are considering it that this is a very real possibility. In fact, it probably will happen, within the next 6 to 12 months. And people should not think that an NDF really provides that much of a cushion against the volatility, of actually owning the coin themselves. And in fact, it can add volatility to it, where, because if someone wanted to, you can do a perpetual overnight swap, for example, where the trade resets every day. That's one way of having, a reset and keeping mark to market slow. Or you can just, take delivery of a coin or close out a position. But if you're basing everything on a fix, even though the fixes are typically, time weighted or volume weighted, you really do add potentially a lot of volatility into your, into your risk management or just, into the whole trade. Because, like I said, we've noticed both in the COVID crash in March of 2020 and this latest flash crash in May of 2021, exchange spreads blew out, and in a lot of circumstances, just there was no pricing for extended periods of time. And if that happened to coincide with an NDF fixing, who knows what would happen? So the documents become paramount with that. So it's just forewarned is forearmed, and we're happy to serve our clients however they want to trade with us.
Super. Yeah, let me tackle another big topic, which is DeFi, decentralized finance. And, DeFi is growing. I mean, it might have moderated a bit with the decline in crypto prices recently, but nevertheless, it's a growing, concept and very attractive to some market participants. Maybe just for some of our audience, DeFi is essentially, as the name suggests, decentralized finance is ways in which you can participate in financial markets that are essentially decentralized. These are, to just put it simply, essentially smart contracts that are running on various blockchains, predominantly the Ethereum blockchain, although that's changing, in which you have essentially financial propositions, be it exchanges or bank-like deposit loan sort of services that are operated from smart contracts. And so essentially this is what DeFi is. But just, I guess the question to all my panelists is, how are banks thinking about DeFi? Should they be thinking about it? Does it represent an opportunity? Is there too much risk relative to, the level of regulation? What do you think?
So we don't participate directly in DeFi because we think there's, we believe that the KYC, compliance risks are too great to actually engage in any of the transactions. A lot of it's being done with anonymous counterparts, and that just doesn't fit our risk profile or our standard practices. As I mentioned before, we've got very strict KYC, KYC requirements and processes. The way we are addressing it is, we're making markets in some of the coins that are used, in the DeFi process, assuming those coins can be traced on either a chain analysis or elliptic, so that we can make sure that we can check the provenance of it and make sure there's no illegal or illicit activities associated with the coin. But just from our perspective, as a principal risk market maker, we feel as though we would subject ourselves to too much potential, regulatory risk, reputational risk by being actively involved in it.
Correct.
Yeah, it's a space that's evolving so quickly. I mean, when you think about it, it's just an 18-month or so project that's gone from about 100 million locked up in assets under value or assets in contracts to hitting a peak of over 80 billion. And so it's growing at a breakneck speed, and we're observing the value proposition of what DeFi provides to users. And there are things like you can deposit stable coins and you can earn a superior interest rate over something like a checking account or a savings account. And so right now we think that DeFi is not necessarily a risk to some core banking businesses, but there are still several challenges to use DeFi. But what we do notice is that it is a space that's growing, that's rooted in open source development. It's got a significant mind share of developers everywhere. It may not be hyper competitive today, but it's got all the right ingredients for innovation and hyper competitiveness. And so because it's evolving so quickly, we do think that it's going to grow more and more popular amongst retail investors and whatnot who are going to look for some of those more creative investments and yield opportunities and returns that DeFi offers. As a bank, though, we are bound by regulation. And so we don't necessarily see a clear path as to how we can offer services or products in the DeFi space. But we do know that the fintechs are maneuvering themselves so that they can. And so we think that there's eventually going to be a CeFi layer, some kind of fintech that's going to simplify the user experience and interactions into DeFi. Users are going to be able to deposit their cash into that CeFi layer, and that CeFi layer is going to do all the heavy lifting of DeFi interactions. They're going to do the yield farming. They're going to reap the rewards and do the strategic investments and management in order to get those returns to their clients. And with that, there's going to be a custody element. And they're going to employ custodians similar to Zodia and so on in order to protect the assets that they have in their custody. They're going to get insurance and whatnot. And so that's where I think fintech is largely going to try to dominate in that space. And they're going to be the first movers before the big banks do, simply because they're not bound by as much regulation and red tape as we are. But they're also exposing a lot of risk. And so there's still so many risk challenges that need to be overcome with DeFi. One of them is the fact that so many DeFi contracts rely so heavily on some of these centralized stablecoins. And if any of these centralized stablecoins become targets of some kind of enforcement action or so on, that can cause a cascading effect that could affect the entire DeFi ecosystem. And so there's several risks that need to be overcome, I think, before DeFi can get mainstream, but it's got all the right ingredients for innovation and hyper competitiveness. And I personally think it'll get there someday.
Super.
Yeah, I totally agree with Karim there, and I won't go over the risks again, but I think one of the key elements that we see is, where clients are now comfortable to hold a crypto asset, so they're holding Bitcoin. They're now saying, okay, how do I actually facilitate, utilize that Bitcoin for additional financing or additional yield, and the kind of the decentralized lending and borrowing pools start to become appealing for yield. But again, I think as we explained at the start, we're at the beginning of this journey from an institutional perspective, and these institutions are only just starting the process to get comfortable with taking a Bitcoin on their balance sheet, for example, to then actually talk about how am I going to earn yield on that asset in a DeFi world is a bridge too far now. But it's something that we all need to monitor and make sure that, especially for us, that our products are fit for purpose for when that does actually become palatable from a risk perspective, to actually facilitate that in the ecosystem.
So we're close to being out of time. Maybe I could just ask each of you to just one quick lightning round, just a couple of comments. If you had to think forward 5 or 10 years, where do you think we'll be in this space? Anyone want to start? Just take that on.
So I mean, I'll take it from a custody perspective. So I think from a custody perspective, it's definitely true that the post-trade world in the crypto space definitely needs a lot of growing up, and to operate like traditional financial capital markets. The fact that that post-trade infrastructure operates on a pre-funding basis, very difficult to move your assets from in a delivery versus payment manner. Really, in five years' time, I expect that post-trade infrastructure to look and feel a lot more like the traditional asset world, and I just see regulation being the main driver to that, and one of the main drivers to adoption. So increased regulation, much more transparency, and the ability for institutions to really enter into this space with a lot more confidence.
Karim?
Yeah, so I'm gonna build off of what I just said earlier about DeFi and having a CeFi layer on top of that. So I do think that you're gonna find some of these fintech players and neobanks are gonna offer far more crypto services. The promise of fintech has always been there to disrupt traditional finance, but it hasn't necessarily lived up to its potential, because fintech up until now has largely been built off traditional infrastructure and traditional rails. I think DeFi and these new crypto asset blockchain rails provide a different angle for them to explore, and they're going to offer more products and services in this space. And we're already starting to see it happen. First, they offer investments in a crypto, which we're starting to see from players like Square. Then they'll start to offer exposure to DeFi tokens, which many of them are now starting to offer, and they're building out that DeFi infrastructure. And then in 5 years' time, they're going to be very active in that DeFi space. That's my prediction.
All right, Rob, bring us home.
Sure. I honestly think that in 5 to 10 years, the overall technology, the benefits will become readily apparent, particularly some of the new blockchains, people, like Polkadot or Web3, things like that. And you'll see a migration of traditional financial instruments, moving to the blockchain, especially for settlement. So I think that's why I don't think it's any surprise that we're seeing your traditional custodians, start to, move in the direction. I really think that's where we're headed. I'm expecting increased regulation globally within the next, 18 to 24 months at the latest. But I think once regulators are comfortable with it, then then the banks and the custodians, or even someone like DTCC, for example, will realize that they have to embrace the technology. Because do we really need someone to stand in the middle when I can, buy 100 shares of IBM if I want, and have the cash taken, from my secure wallet, sent to my broker, and then him, instantaneously move the 100 shares into my secure wallet. Same goes for, fixed income swaps, especially, so yeah, I think it's going to be lots more blockchain. The DeFi is exciting now, but I think there's going to be some major regulatory hurdles that they're going to have to clear, particularly around the know your customer aspect of it. But I'm sure that anything that offers excess returns is going to attract the attention of regulators, right? It's just a matter of time. So
yeah, all right, super. Well, thank you, all of you. I know we're out of time, but I really appreciate all of our panelists. It's a terrific discussion this morning. So thank you, everyone. And Bridget, I'll hand it back to you.
Thanks. That really was a terrific discussion. Thank you, Tim, Kareem, Luke, and Rob. Really appreciate that. We'll now take a very brief break and a word from our Sapphire sponsor, Gibson Dunn, before we reconvene and hear from Congressman Warren Davidson for some legislative insights. Good morning, Congressman. We'll be starting up in just a moment.
Okay, thank you.
Thank you. Welcome back, everyone. We are really honored to have with us today Congressman Warren Davidson, who will shed some light on what is, or at least might happen, on the Hill regarding digital currencies. Congressman Davidson represents Ohio's 8th congressional district, so I'm a Buckeye as well, other part of the state. He is a member of the House Financial Services Committee and ranking member on the House Task Force on Financial Technology. After high school, Congressman Davidson enlisted in the Army as an infantryman. As part of the 3rd Infantry Division, he was stationed in Germany and witnessed the fall of the Berlin Wall. After graduating from West Point as an officer, he led in the Old Guard, the 75th Ranger Regiment, and the 101st Airborne Division. After the Army, Congressman Davidson returned home and worked with his father, earned an MBA from the University of Notre Dame, and spent 15 years owning and operating manufacturing companies in Ohio. In 2016, he again responded to the call to service and came to work in the U.S. House of Representatives. Congressman, thank you so much for joining us today. The floor is yours.
Thanks. It's an honor to join you all. And really, I'll spend a little bit of time answering questions if that works. But I wanted to just lay out one of the areas of regulation that's finally got traction is stable coins. So stable coins are a tokenized digital asset that are backed by something that people view as a stable store of value. The most common are US dollar coin and, Tether. So Tether, is older and, probably more widely known. And they shared recently a disclosure that the composition of their holdings isn't cash only. A lot of it's commercial paper. And frankly, a bigger percentage of their holdings are commercial paper than some money market funds. So if you recall, back in the 08-09 financial crisis, some of the net asset value broke the buck. And so the funds were no longer really $1 funds, created all sorts of chaos. We spent a fair bit of time trying to provide regulatory clarity. And of course, those things are securities. They have required disclosures. And for that reason, we know the composition of their commercial paper, the credit ratings behind everything they hold. And you don't know that about Tether as an example. So a lot of people have said, well, I don't know about all stable coins, but I do think Tether probably looks a lot like a security. They're backed by securities. On another note, I'm not sure that the folks that met with the Treasury Secretary yesterday are all thinking about this the right way. And for this reason, we tried since 2018 to get something called the Token Taxonomy Act, and it would provide a bright line test for when something is a security and when it is not. And people that follow securities law know that there's a longstanding Howey test that regulators try to apply that came from a court case about orange groves. So essentially, there was speculation that there would be an orange grove. They were going to buy the land and do this. Well, it starts looking like an investment contract. You're taking the money. That's going to be treated like a security because you don't yet have an orange grove and you don't yet have oranges. So in applying that to digital assets, sometimes it turns into an art, and the reality is it's been artistically applied. That's at the heart of the XRP Ripple case in this, digital asset space. Is it really a security or not? So we need a bright line test. We need it for the market. We need it for consumers, investors, and we need it for the regulators themselves so that there's clarity. If you simply apply something for stable coins, the reality is you may muddy the water behind securities as well. So I want to highlight one other stable coin, which is Paxos Gold. Paxos has a number of digital asset products, but one of their tokens is Paxos Gold. And it's literally, a stable store of value in the sense that one tokenized Paxos Gold represents 1 ounce of gold. So oddly enough, it matches the market price of gold. So gold clearly not a security. And just because you tokenized gold, to me, doesn't mean that you would treat that as a security. So the idea that you come up with one standard for stable coins and say, well, all stable coins should be regulated in this way, to me would really kind of create a whole different body of securities law or banking regulation or whatever, when what's really needed is just that bright line test that's in the Token Taxonomy Act. And if you applied that, whether someone wants to call it a stable coin or not, you could easily say it is a security. So I don't think we're going to move that bill as fast as regulators will take action. But we are reaching out to the SEC to try to make that case that in their rulemaking, they should go in this direction instead of just a narrow regulation that focuses on stable coins, because the comments from Chairman Powell at the Federal Reserve, to me are a little concerning. And when he testified before Congress, he essentially said, well, we could just create a central bank digital currency, and then there would be no real need for stable coins or even all cryptocurrencies. And I think that's very out of sync with where not just American markets, but the global market is. And frankly, it would miss a massive opportunity for innovation. That might be part of the point of his goals, because it really does protect the status quo quite nicely. But it would essentially do that at the expense of an incredible fintech revolution that it really is underway. And it could be really damaged by getting this regulatory piece wrong. Think what would have happened if we allowed the Postmaster General to kill email. And think what would have happened is, well, we successfully killed email, so we really don't have a need for this internet thing. Think if Paul Krugman was the person that we listened to and made him Secretary of Treasury when he thought that the internet would be as short-lived as the fax machine. Thank goodness we didn't listen to some of those bad ideas, and instead Congress passed the Digital Telecommunications Act in 1996, and we saw the internet age flourish, and it flourished first and foremost in the United States of America. We have the same opportunity with this fintech revolution today. It's certainly bigger and broader than stable coins or even digital assets. But I'm sure you guys are trying to find ways to make this work for you and protect yourselves, on the other hand, from the potential disruption of this incredible technology. So I look forward to your questions, and thanks for the invitation to join you all.
Oops. Thank you, Congressman. So speaking of the legislation, it would be interesting to hear from you. What are the challenges in getting the legislation to advance? I know one challenge we've heard is all the differing jurisdictions. Of course, we see that in the regulatory space as well. So maybe if you can share kind of a plan for moving this forward, and sort of the type of support that you've received to date.
Yeah, thanks. So the Token Taxonomy Act has always been 100% bipartisan. Darren Soto from Florida and I introduced it, and we agreed that we didn't know how it would take off, who among our colleagues would like it and who wouldn't. It really doesn't break on party lines, but it has kind of developed a slightly bigger following amongst Republicans. I'm not really sure why that is, because in the market, a lot of the companies that are launching it in the innovation, if you surveyed their workforce, they would be well left of center. So in Congress, though, it's kind of different in that sense. So in terms of moving the bills, there are a lot of interests that are affected by this space. And in this particular case, the interests that would be most affected are some of the biggest lobbyists, biggest presence on Capitol Hill, and they've spent fairly extensively to preserve their status quo. So they already have all the relationships, they get all the meetings, and their issues get heard on a host of issues. And because this is a kind of new space, it doesn't occur to most people that, hey, early on we should make sure that the government doesn't kill us. And frankly, this whole sector is kind of waking up to the idea maybe we should spend something on the political path, and that's kind of left them a little behind the eight ball in terms of where the interest goes. And if you're going to become chairman of the Federal Reserve, odds are you didn't come out of the fintech space. If you're going to become Secretary of the Treasury, odds are good you didn't come out of fintech. The one exception to that recently was Brian Brooks, who led briefly the OCC, and unfortunately wasn't able to be nominated and confirmed in the position. He was very proactive, kind of stretched the bounds of things, and I think did that, in part because he knew he would have a very short-lived tenure, and he did help create some of the attention this is getting because he took action, and in a way that Congress has been unable to. I couldn't get the hearings on topic that I wanted, so I started just hosting a meeting at the Library of Congress as an example. And so we are talking a little more productively in Congress, but I think almost no one expects Congress will actually get out in front of this issue instead of seeing regulators take yet another action. So that's been the frustration in it, and part of why Congress is a little slower than maybe even normal on this issue.
Mhm. So curious, this is a very, challenging topic. How, and it's something that you're clearly quite knowledgeable and passionate about. How did that come to be? What's your sort of personal interest in this?
Well, I personally started taking interest in the space because, so you mentioned a little bit about my military background and then my business background. So I got out of the Army in 2000. I got into manufacturing, and during that stretch of years, inherently manufacturing has involved some international trade. So I got involved in the international payment system, and we had numerous supply chain disruptions over really wire transfers. I mean, initially we couldn't move money from the United States to China. We would essentially move it to Hong Kong, and then Hong Kong would pay China, and the goods would ship from China to the US, but the money didn't have as direct of a route. And then, even then you would wire money to a supplier somewhere, China or elsewhere. And they would always say, well, we haven't received the money. And like, I sent a copy of the wire. Your bank has received the funds. And they're like, well, I don't have it in my account. So you're always sitting there. Now, part of that's an excuse sometimes for people to ship late. But the reality is when you dig down into it, there really are issues in the current payment system that create lag, sometimes a whole week. And, that's a potential, 3-4 days without production if it's an unexpected, change to the normal flow of goods. So, what does that do? It drives more inventory costs. It ships late. We had a standard, don't ship late, don't ship partials. And so I started looking at, there has to be a way to do money differently and peer to peer, so I don't have all the intermediaries and friction. And that led to early things like DigiGold, eGold, or DigiCash, eGold, and other things like that. And in 2013, I kind of missed it because the 08-09 financial crisis was pretty intense in manufacturing, and we started growing on the back end. But so I was a little late. I didn't hear about Bitcoin in 09, but I heard about it in early 2013 and started paying close attention to it since then. So when I came to Congress, I started looking at what in financial services needs attention. And, in Congress, you find issue areas where a member picks up and champions a issue. And there's nobody really working in the crypto space. Nobody that had much traction on it. If there was anything, it was kind of a nominal effort exploring the issue. I already understood the issue pretty well. And the ICO market was going nuts in 2017. So that was when I was first on the Financial Services Committee. And, we were like, well, shouldn't we be doing something about this ICO blow up? And so since then, we've worked hard. I spent all of 17 and most of 18 trying to get a hearing on things that were, to me, rightly focused. And that's when we started the working group that led to the Token Taxonomy Act in the fall of 18.
Well, it's always great when a member has that sort of practical, personal, experience with an issue, because you really look at it as problem solving. And, at the IIB, our members are very knowledgeable about cross-border payments. So to the extent that we can be helpful to you, please let us know. So you mentioned concerns about, sort of regulators getting ahead or too far out ahead of Congress in this regard, and noted that Secretary Yellen has put stable coins on the FSOC agenda. In addition to sort of the federal regulators, there's been action in the states and potentially more. Curious to the extent that, and this might be answered, and I'm just not familiar with this aspect of the legislation, but generally, what are your thoughts about the need for, a federal standard, like preemption federal standards? There would just be one set of rules around this.
Yeah, that was a controversial topic. It still is.
It always is.
The Wyoming folks want to preserve their first mover advantage. And the only senator that's really shown a strong interest in this space is Senator Lummis, who is, passionate about protecting Wyoming's first mover advantage. So she doesn't like that aspect of my bill, which, creates a federal standard, a preemptive standard, so that you can move these things in a standardized, common way. I think the logic of it says that there has to be preemption. We had an open comment period. We intentionally drafted it in 2008 with no preemption, in deference to some of the people that were early and helpful. But we said, look, we want to get comments. So we put a period in, we dropped the bill originally in December, and then we were going to go into a new Congress. So we knew that bill wasn't going to get a vote. The goal was to reintroduce it in February after the comment period. And it was just overwhelming. I think we introduced it in like early April, because we just had so many people that wanted to weigh in on the issue in the space. And I mean, early on, the goal was to get 12 to 20 people. We had to cap it at 50 so we could have meaningful participation, but we probably could have had 300-400 in attendance if we accepted all of the requests. So, we had, for that fall of 18 piece, we had like NASDAQ, State Street, Fidelity. You had, early stage companies in the space. You had Coinbase, Andreessen Horowitz, the venture capital people. I mean, and people didn't send just, a representative. They sent like their CEO, CFO, general counsel, folks like that were part of this hearing. So that created its own desire to be there. Then we had, top business schools. I remember some of the collaboration we did with Wharton on this. So, that produced a number of changes, but the biggest one, and clearly the one that is going to be featured as a sensitive topic, is preemption. But I think the logic says you have to have preemption.
Mm-hmm. I don't envy you trying to navigate that. Do you have time for one last question?
Yeah, sure.
Great. So the Anti-Money Laundering Act amendments that were adopted last year, thank you, expanded the definition of financial institution under the Bank Secrecy Act to include businesses involved in exchange and transmission of value that substitute for currency. Interested in your thoughts about how to address money laundering and the terrorist financing, countering terrorist financing, if we move into this digital currency. And I don't mean just central bank digital currency world. What else do you think might need to be done? How are you thinking about that?
Yeah, so I think that it's important to recognize that the current approach to bank secrecy, anti-money laundering, know your customer provisions doesn't work. So there's a lot of attention on crypto in particular, saying, oh, it facilitates money laundering or tax evasion or any number of other types of illicit finance. The reality is, FinCEN themselves, numerous outside reports show that it's less than 1% of the illicit finance that's out there. Overwhelmingly, the current architecture facilitates the illicit finance. Certainly cash is part of it, but plenty of wire transfers and existing things, in spite of all of the things that you and your members do. Essentially, as long as you do an adequate job spying on your customers, the governments around the world let you operate. If you don't, then you're not allowed to operate. That's kind of the terms of service for running one of these banks or other money service businesses. And I think we need to look at that and say, candidly, the current system doesn't really work. It's ridiculously expensive. It's duplicative. There's not much utility for the bank other than being allowed to continue being a bank and not getting dinged by regulators, because you don't even know whether your stuff's being effective. What you spend, I mean, in the biggest bank's case, literally billions of dollars complying with this system. And you have all kinds of reputational risk by even being accused of not doing it well. So I know a lot of the banks implicated in the BuzzFeed article last fall, September 20th of last year, weren't happy with that article, the FinCEN files. But why? Because you have reputational risk if there's a failure. But if you look at the amount of money that's moved, well, not much of it overall is illicit finance. And I think we just have to look at it and say, yeah, we haven't eliminated the black market in any country or any economy in the world. There will be a black market. What do we do that makes it harder to have black markets? And I think rather than focus on, oh, there's some unique risk to crypto, it's no, the current system doesn't work. So rather than doubling down on a system that already doesn't work, we ought to think differently about that. In my view, we ought to think differently about the whole third party doctrine that says that, you know, your customers have no expectation of privacy because they shared information with you. I think that's nonsense and a complete violation of the Fourth Amendment. I think the cases on that topic were wrongly decided. It's essentially the government forcing you all to do what they wouldn't be allowed to do themselves. And to me, that's unconstitutional. So we have a chance in this space to really reclaim the Constitution, to lower the effective tax rate on money service businesses, because if you think about it, it's just a massive tax that you don't pay directly to the government, but if you don't pay it and fund it, then you don't get to operate your bank. And I'd say lastly, it's not even a well-stated tax that you can do, because you never really know how much is enough. Well, a little bit more. And if you had a defined tax rate that was going to fund this the right way, you do it. I think that while it was right to apply, you know, similar regulations to similar activities to avoid the arbitrage opportunity, what it really should be highlighting is the current approach is broken.
Well, we certainly can attest to the resources devoted to compliance and welcome approaches that would promote efficiency and effectiveness of those regimes. And you know, I think this presents opportunities for that. So thank you for your thoughts on that. And thank you for joining us today. This was really interesting, and thanks for championing this, you know, important topic. It's really, it's hard to move new issues to advance them in Congress. So kudos to you for that. And again, to the extent we can be a resource, you know, please let us know.
Yeah, thank you. It's an honor to join you. But yeah, definitely an understatement, and it's hard to move something new through Congress. But thanks a lot. Appreciate it. Best of luck for you guys on your conference, and you know, hope it all turns out well.
Thank you, Congressman. So we're going to take a short break, and we will be reconvening in a couple minutes. We're going to have a word from our Sapphire sponsor, Exeger, and our Diamond sponsor, White and Case.
Hey, everybody.
Okay. Welcome back, everyone. I'm pleased to introduce our next panel on legal and regulatory implications of dealing with digital currencies. Doug Landy, co-head of White & Case's Financial Institutions Industry Group, who's a partner in the global financial services regulatory and fintech practices, will moderate this panel. He'll be joined by Dan Sanjeep, Deputy Superintendent of Banks at the New York Department of Financial Services, who is probably listening carefully to the preemption discussion in the previous session. Uzman Sheikh, National Head of the Blockchain and Smart Contract Group and National Litigation Lead of Securities Compliance and Investigations at Gowling, and Phil Angeloff, Counsel in the U.S. Financial Services Regulatory Group at Clifford Chance. Doug, over to you.
Thanks, Bridget, and thanks to everybody for dialing in. We appreciate it. We have a great panel. We're going to be focusing on the legal and regulatory implications of digital currencies and blockchain and related matters, looking at it from the bank side, which is a somewhat overlooked and under-discussed side, I think. We have a great panel here. We have representatives, as Bridget just said, from regulators, from US law firm, and from Canadian law firm. So we have sort of covered a bunch of different bases. So what we're going to do, I'm going to speak for a couple minutes, and then we'll go through each of our panelists who have different things and different topics to address. Please, if you have questions, put them forward during, if you want, and we'll be able to address them, or hold them till the end, and we'd be happy to tackle them then. So this is an area in big flux. I mean, just look at yesterday, we had the President's Working Group on stablecoins and the senior regulators there. And we know from that meeting, there'll be a Treasury report on stablecoins coming out in the next couple months. So why? It's a time of great opportunity and sort of great confusion. We see the largely unregulated world of digital currencies, digital assets, and blockchain-based products, which have grown up outside of the regulatory system, beginning to collide with the regulated financial system, both by terms of demand, interest, and so on, which was always going to happen, but it's caused the regulatory response to really be playing catch up, and the legal response really to be playing, does it apply or not? We have things that are open right now, like the FDIC's request for information on banks' digital assets and digital asset activities that was issued in May. We have the OCC's version from last year. We have the agencies recently providing guidance on third-party relationships to expand their previous regulatory issuance to include more digital service providers, such as cloud providers. But what do we need? We need legal certainty. We need some regulatory guidance here before banks can really engage in digital assets as they do with other financial assets. Very briefly, the SEC, as we've heard before, has explained somewhat when digital assets may be securities. CFTC has claimed that most of them are commodities. We heard discussion of the OCC, 2 of the 3 letters, there's a third one as well, allowing national banks and therefore many other banks to engage in digital assets through custody, through payments, and through account services. We have not heard from the Fed and the FDIC. We just said the FDIC has an open request for information. The Fed has said, Chairman Powell has said several times, the Fed's coming out with a report. It was supposed to be this month originally. I think it's now for September, but it is imminent. The states have been very active. We'll hear from Dan in a minute, but certainly New York has perhaps the most comprehensive regime out there. Wyoming and other states have also been very active, and we know that there's many others following. And finally, we need just to have a common understanding of what we're talking about here. I always like to start these seminars or talks with the idea, that virtual currencies may be virtual, but they're definitely not currencies, right? None of them are. They are just financial assets of a kind or another. There are no such things in the United States. Perhaps, as we heard earlier, CBDC may be at some point if the Fed decides to issue it in that manner. So what are these assets under banking laws, securities laws? How do banks lend against them, custody against them, trade them? How do banks give or receive services provided to them? So what are we talking about here? Banks are starting to move into this area. I hear interest from my clients, tentatively, but consistently, both US banks and FBOs. We've certainly seen JP Morgan be very active in the area and other banks following. So we know the market's rapidly developing, but what we don't know is how it's going to continue to grow, but we can't ignore it. Okay, I think Usman, you're going to start and set the scene for us. Is that right?
Happy to start. Well, thanks a lot, Doug. As Doug had mentioned, my name is Usman Sheikh. I'm a partner at Gowling WLG in Toronto, Canada. I oversee a quite global team of about 40 to 50 lawyers, as it turns out, who are practicing in this area, including on projects with banks. So what I thought I would do is just provide some high-level thoughts on key legal and regulatory issues that we've encountered, including with banks dealing with digital currency projects. And toward the end of my comments, I wanted to perhaps provide a few practical tips to those of you who are working on these projects at your organizations in terms of what we have seen work well or has not worked well. So I guess before just diving into the legal issues, the first point I thought I would emphasize is that there's quite a wide variety of blockchain, digital asset, digital currency based projects involving banks that we're seeing. And I won't dive too deeply into these because I believe other panels and panelists are covering this topic, but we have seen quite a lot of projects, what I call blockchain 2.0 projects in this area. And what I mean by that is really using the core infrastructure, the core technology to bring efficiency to a bank's operations or to the industry as a whole. And it may or may not involve a digital asset or not. So think about what Doug had just mentioned, JP Morgan's efforts on the payment side. We've also seen loyalty point programs that are being tested. We've seen trade finance projects. We've also seen a lot of projects involving KYC. We have a quite interesting project up here in Canada involving about 6 to 8 banks called verify.me, where an individual can actually, on a blockchain-based system, verify their identity at one bank and then use that identity based on that with other sections of the bank, or even to get access to information at other providers. So just the other day, I got my tax information using RBC's KYC identification of me through that system. We've also been seeing quite a number of crypto asset proper-based projects involving banks. As Doug was mentioning, some banks are considering or now allowing clients to buy or sell digital assets, including through the investment channels. Some banks are providing banking services to crypto players. We've also been seeing quite a lot of activity on the CBDC and stablecoin front as well. All to say, I think the point that I wanted to emphasize here is that there's many types of projects that we're seeing relating to banks, and each one really comes with quite unique and novel regulatory issues, and they very much vary project by project. So let me, if I may, just dive into a few of those issues, particularly those that we see popping up time and time again involving digital currency projects. The first, and Dan really touched upon this, is one of the key issues that we see is the legal characterization of the digital asset. In fact, I think this very session is called Legal and Regulatory Implications of Dealing with Digital Currencies. But really, what is the digital asset, as Doug was mentioning? How do you legally characterize it? Is it a security? Is it a commodity? Is it a currency? Is it some of the above? Is it all of the above? In the blockchain space, there are over 2,000 digital assets, each with a very unique genesis, use case, very unique structure behind it. A digital asset called Bitcoin, which many of you may have heard of, is very different from a digital asset known as an NFT, or a non-fungible token. Both of these are very different from a CBDC, or a central bank digital currency. Those are very different from a digital token that was ICO'd, or initial coin, or was issued through an initial coin offering. Unfortunately, as I think Doug was also mentioning, there have been very few official regulatory pronouncements on the legal characterization of these tokens, even Bitcoin for that matter, which has been in existence for over a decade. Many of our legal tests, certainly in Canada, and I believe in the United States as well, to assess and determine the legal nature of the asset are quite subjective. You may have heard of the Howey test in the United States to determine whether a token is a security under the investment contract test. We have a very comparable test in Canada called the Pacific Coin test. The challenge with many of these tests is that reasonable people can reasonably disagree as to whether the token or digital asset is a security under that test. And there's been quite a number of quite famous battles of late on that very issue. A few cases that you may have heard of are the Telegram case, the Kik case, the case involving Ripple is currently playing out in the courts. And just a matter of a few days ago, the SEC approved a settlement involving a case called Coin Schedule, where in a public statement issued by SEC Commissioners Peirce and Roisman, they noted this very dilemma, because in that case, that company was publicizing on their webpage over 2,500 digital assets, and the commissioners expressed significant concern that there continues to be a decided lack of clarity from market participants around the application of securities laws to digital assets and their trading. They noted that the Howey case is helpful, but its application to many digital assets is not crystal clear. So you may be wondering and asking yourself, why is this important to you in the banking sector? Well, for very much the same reasons that Doug had mentioned, which is, excuse me, how do you custody something without knowing its legal characterization? How do you interact with a digital asset when there is effectively a sword of Damocles above its head as to its lawfulness? There is some level of light at the end of the tunnel, and there's a number of guidance pieces that have now been issued. There's also individuals such as Representative Patrick McHenry hoping to bring clarity to this, including through a latest bill to create a crypto asset, or rather a crypto task force on digital assets. And so we're going to continue to watch as legal practitioners this area play out. I thought I'd just touch upon, if I may, Doug, just two other products and players or other issues that we are seeing. And that is that separate and apart from the legal characterization of the digital asset or the digital currency, whichever word may apply, which is an evolving area, so too is a regulatory regime relating to many of the key players and products that exist and that are vital to this ecosystem. You may have heard of the concept of a crypto exchange. These are platforms that allow parties to buy and sell crypto assets. We don't call them crypto exchanges in Canada. The term exchange is a very, very defined term. So we use the term a crypto asset trading platform. And there's many different types. There may be a centralized platform. There may be a decentralized platform, basically entirely consisting of smart contracts with no humanoid behind it. There may be OTC style models. These platforms are quite unique because our capital markets had always presupposed and assumed that there would be segregation of function between intermediaries. And these platforms, however, many of them effectively merge what are functions that are quite distinct, meaning an exchange function, a clearing and agency function, a custodian function, a dealer function, all effectively into one. And our regulators, certainly up in Canada, were grappling for the longest of time as to how to address these. And so only recently in Canada, just about a few months ago, a regulatory framework was designed for these platforms. And since that time, one of the largest regulators, the OSC, has been saying to regulators, either comply or you will face prosecution. You may have heard about this in the news, but since that time, over the past month and a half, Over 3 major prosecutions have been commenced in this area. I understand the same is occurring in the United States, with quite a number of statements now being made by regulators and others focusing further attention on crypto exchanges or crypto platforms. We've seen SEC Chairman Gary Gensler noting that further regulation may be required. We saw just this month, Senator Elizabeth Warren sent a letter to the SEC asking for regulatory gaps to be closed and other regulatory movements to be made. I'll just touch upon crypto funds as well, if I may. This is another, in addition to crypto players, we're seeing key crypto products also under regulatory scrutiny. And in Canada, certainly in the United States, that applies to funds and ETFs that consist of digital assets. In the United States, an approved Bitcoin ETF continues to elude the US. I understand just this month and last, the SEC postponed its decision on several ETFs. In Canada, we've had our fair share of battles in this area. There's actually a famous case called 3IQ, where our director of investment funds refused to receipt a prospectus involving a fund that would be entirely consisting of Bitcoin, and that was challenged on appeal to the Ontario Securities Commission. Decisions of directors on those issues get challenged to the commission itself, where the commission disagreed and required that a receipt be issued and that these products be made available. The OSC held that it is not the role of securities regulators to approve or disapprove the merits of securities being offered to the public or to immunize investors against risk of loss. The public interest jurisdiction of our regulators is broad, but it is not infinite. And while the directors' concerns, they said, were warranted and should be taken seriously, they did not believe that it warranted denying a receipt to allow these funds to go forward to the public. They did not believe that there was sufficient evidence of market manipulation that one could still not achieve price discovery in relation to these products. And they noted that other tools were available to address a number of the directors' concerns, including on issues of custody and the issue of audited financials for the fund. And so they found a number of workarounds surrounding that. So in Canada, in fact, we now have several closed-end funds as well as ETFs, including Bitcoin and Ether in Canada. And I suppose the implication for all of you in the banking space is that many of our clients, and I think, Doug, your experience is the same, our banking clients are still relatively nervous, but are watching this area intensely. And we've been seeing a number of our banking clients, although they have significant nervousness in the area, are getting a tremendous amount of inquiries from their client base to get into these products. And a number of our banking clients also see a tremendous amount of opportunity. So I will just end with this, and that is just a few tips. So for those of you in this sector, what you should do, what we have seen not work so well, I suppose, is that law should be considered at the very beginning of your projects, not as an afterthought. We've seen many projects fail because developers have gotten very far along when the project had a fatal legal flaw. We would also encourage that parties form internal working groups with developers, legal practitioners, and the business line. We've seen a lot of projects fail because projects got very far along, but did not have executive sponsorship at the board level. And we would also encourage you to reach out to regulators. Many now have sandboxes to discuss and raise novel issues, including the SEC FinHub, the OSC Launchpad, and others. So with that, I'll perhaps hand it back to you, Doug.
Thank you, Usman. Couple questions for you. As you note, the US has been slow in issuing ETF approvals and similar things, while Canada has gone ahead and done so, creating a great case study opportunity, for how two very close economies deal with sort of a similar issue. In the US, the SEC has cited sort of consumer-related issues, the lack of exchange protections and other things that ETFs would commonly get on better known and longer run securities exchanges. Have there been any issues, with these funds in Canada? What are the lessons that, we can learn from them? And certainly, as you know, we've seen people in the United States say buying Bitcoin and then using the Canadian funds that are available to hedge that risk, intertwining these things even more. So the price has gone up and gone down very rapidly in the last year. Have we seen any issues in the fund sector? Guzman, that was to you. Can you not hear me, Guzman? Oh, well, you may be muted or off. All right. Well, let us move on. I think Dan, you're up next to talk about the DFS. Maybe having some technical.
Yep, Dan Sanjap. So I just want to start with a standard disclaimer. This is just my personal views and ideas. It's not anything that reflects anyone else or the agency, so please don't quote them back to me at some future point. So I think the challenge, the big picture challenge for folks who have the level of expertise that the members of IIB have is to not be blinded by the expertise, right? You understand, the financial sector, you understand cybersecurity, you understand BSA, AML, but you have to really approach things with a very sort of blunt perspective here and not assume that the things you know in a somewhat different area are easily transferable to this new area. I think that there's new challenges here that require rethinking. Some of the usual practices, again, people have a lot of expertise, BSA, AML, cybersecurity, but you need to think about where this is a different situation and where doing the usual thing may get you into trouble. So I think that the very first thing that is worth just covering is, where are we with the internet, right? I mean, the perspective I have is we're living in the golden age, not of the internet, the golden age of internet piracy. Right, the design of the system starts going back to 1969. You have the Defense Advanced Research Projects Agency designing the first network. Think about what that network involved. It was everybody had been vetted, everybody was known, and everybody had a security clearance. And we never really reconsidered, I think the security aspect wasn't that important there because it was built into the people, it was built into the systems. But over time, we've created this network that has become global, where security is not built in, and so I think of it as sort of the internet high seas that you could go back when the golden age of piracy was around, and it's not really patrolled. There isn't really a police force guarding it. Anyone can get on there. Anyone can hide in the nooks and crannies, and literally every day, right, there are millions of robots knocking on all the doors with a little sledgehammer to see if they can get in. So I think that you have to be aware of that idea that it's not a secure system. I think the metaphor that helps me most of all is to say, look, we have what is the internet? It's a plumbing system. It's a set of pipes, except when we designed this set of pipes, we decided, we're going to run the sewage and the clean water through the same set of pipes. Are you surprised that there's contamination? You shouldn't be. It's set up. It's not set up to prevent it in any way. So it's a catch-up game where we're always patching. Every time things are changing, there's new vulnerabilities being created, and I think that is hugely relevant to cryptocurrency because, right, it's cyber currency, it's virtual currency. It fully exists and I think that the folks who have been successful in this area, right, it frequently have come from the engineering side. Or the venture capital side, and they have been very blunt and realistic about the challenges that they're facing, and so they've tried to redesign systems from the ground up. And I think that what we have seen at DFS is, wow, truly, thoughtful, truly careful, highly conservative approaches to avoiding the risks that having a purely virtual currency creates, right? It's so slippery. It's so, the ease of having transactions, global transactions around the world is so easy that actually creates the problem. So, right, there's always a balance between efficiency and security. And You can make things very efficient, very, ease of use for the customer. You just have one password. You don't have encryption. You don't have multi-factor authentication, but, you give up a lot of security. And so you have to strike a balance where you may think that it's burdensome to do multi-factor authentication, but it is a crucial factor to, again, improve us on a system that is, no one really oversees. It's sort of been cobbled together over time. And I think that is the context that you have to never forget where you are today if you're going to design a business plan and a set of procedures and compliance procedures that are going to be effective. So turning to virtual currency, I mean, the first thing that I want to say is it's a little bit of an advertisement, right? DFS jumped into this area early. We were first. I think all the other federal regulators are still playing catch up. I started working on virtual currency when I got to DFS about 6 months after 2013. And, we got there because we were concerned about customers. Mt. Gox had blown up and we realized that, people are going to go in this area, whether or not, the SEC takes timely action or not. And we want to highlight that, when there are good companies, we want to, not allow bad companies to do business in New York. And we want customers to know that there is a difference, right? From the outside, it's very difficult to tell the difference from about some of these companies. And so, right, this is why there's bank regulation. People go into banks from the outside, the bank can look very solid, but you need an independent voice to look in there and sort of check the books and knock on things. And I think that was the goal. The goal was to protect consumers by creating some standards and helping to weed out the good from the bad. I think one of the challenges with the growth of virtual currency, especially particularly Bitcoin, become worth a tremendous amount of money. There's a lot of money that's gone into it. You have to kind of remember a little bit that, I mean, from my perspective, it is an amazing technology, but Bitcoin to me is version 1.0. Bitcoin is the Kitty Hawk. So it's true, amazing technology. Kitty Hawk is amazing technology. Would you want to build a business called Kitty Hawk Airlines? How much money would you want to value that business? How much money would you want to put into that business? I think the message here is it's a technology. And I think that the question is, how useful is it? How is it going to develop? I'm looking forward to 2.0, 3.0. Again, I think every new advantage for the folks who are very serious in this area, Ether trying to build something a little different, everyone trying to come up with different ideas. Unfortunately, there was a big jump onto Kitty Hawk Airlines, and the question becomes then to have our banks be very conscious of, I mean, everyone's very conscious of the volatility, but I think I want to take it a point further, which I will say is, I think it just needs to be said. You never know when it's going to go to zero. I mean, I know people are telling you, Bitcoin is digital gold, et cetera, but I can recall during the time period that I've been working on this, which was a few years, but not that long, a couple of times when there were systemically, these oops that potentially had a significant risk. There was a point where, after many years of use, they discovered a flaw in the Bitcoin code that potentially allowed double spending. I think that they caught it before anybody else caught it, and so they managed to fix it. There were a lot of copycat coins which also managed to fix it, except, before it got caught. The coin that I know the largest coin that got caught was a very small coin. I think it was called Pigeon Coin. They didn't fix their code, and someone, basically destroyed their system because they didn't fix their code. But again, that was many years after it had been around. I don't rule out, I don't know myself, but I don't rule out the possibility there could be another flaw that everyone has overlooked for 10 years. These things can still happen. The other part is, who are the miners, right? The miners that support Bitcoin are supposedly independent. However, at one point in time, I do recall a news item some years ago where miner consortiums had formed, and two miner consortiums decided to combine, and they discovered that if they in fact did combine, they'd have over 50% control over the system, which potentially allows them to do all kinds of strange things. Now, they don't necessarily have that incentive, because if they have a lot of Bitcoin, they would be destroying their own asset value. But again, there's a lot of unclarity as to where the miners are, who the miners are, what percentage of them were in China at one point, what percentage of them have moved out. Again, there's some issues there. So again, the point is version 1.0, absolutely, sell picks and shovels at the gold rush, but don't necessarily assume that, the gold is what the bank wants to have a commitment to itself. I think providing services are very different from providing investment advice, or that's obviously not what the banks typically do. And as far as what virtual currency is, again, this is where I come back to the regulatory delay. I think some of the federal regulators do move slow. Here's my comment on preemption. You could preempt, but the states are the laboratories of democracy, right? The states are the ones that innovate and respond quickly. New York responds quickly to financial innovation because we have a lot of it here. If you were going to wait for the SEC to decide whether coins are a security or not, guess what? Hundreds and thousands of coins have been launched. And if the SEC had to do it all over again, maybe they would have, had a very different point of view as to, whether any or all or most of those are securities. I mean, I think it's a very complicated issue. And I think they specifically said on some stories, look, the horse is out of the barn. We're not going to be able to shut down, Ether or Bitcoin or that. And, you deal with the situations you find it. And so they're in that situation. DFS is in that situation as well. We just got in a little earlier to try to raise the standards in the industry. And so I think in assessing what is going to go forward and what is going to be around, years from now, I think people have that discussion. I think it is important. I think if you're building an entire ecosystem around Bitcoin, you have to ask the question, is version 1.0? I mean, the only technology version 1.0 that I think is caught on right away, and version 1.0 is still the one in use. I think I call it Fire 1.0. I think Fire is still in use, but every other kind of technology that humans use has been significantly improved. And so there's a lot of talk about the network effect of Bitcoin. And, Bitcoin was first. It has a first mover advantage. Absolutely, hugely true. We're still using the QWERTY keyboard for typewriters that was invented in 1870. It's hugely inefficient to have letters like E and T outside of the home row. A more efficient keyboard was invented like the 1930s, the Dvorak keyboard, but we're still using QWERTY. So I think that is a fair point, but you also want to go back to more recent events. For example, the dot-com bubble in 2000, right? To translate that set of justifications into what we're seeing today in the Bitcoin ecosystem, people say, oh, Bitcoin has the most eyeballs. Well, what's the profit from Bitcoin? What's the revenue from Bitcoin? Don't ask that. It has the most eyeballs. And that's potentially true. When we're first getting involved in Bitcoin, people are trying to come up with valuations. I do recall, equities analysts doing an analysis of, okay, if Bitcoin became a widely used payment system and everyone was using a fraction of a Bitcoin and it was being used for this many transactions a day, this many transactions around the globe, you could project how much its value would have to be in order to capture all that. But here's what we know now after some years is Bitcoin is not a payment system. It doesn't work for that. And I think this is a good segue into the cybersecurity point. So you have this asset that is meant to be very efficient, very decentralized, and it turns out that it is so efficient and so decentralized that you have to be hugely careful with what you do to protect it. I think I think our banks are hugely experienced and hugely knowledgeable about cybersecurity, right? We have DFS also came out with a cybersecurity regulation to again raise the standards, make sure that people are on top of things there. And I think the issue there is again the blinded by expertise. I think that you're seeing in some sense, or at least we were seeing in some sense, the same division in cybersecurity as you previously saw in the financial modeling of subprime mortgages that led to some of those failures. You had the folks who understood the math and were doing modeling and were quants, and you had the folks who were experienced financial managers and understood things like people might mislead you on loan applications, people will lie, people will take things fast. And I think that there wasn't a real communication between those two sides. And so the quants were delivering a model, and the folks who were the experts were, the more experienced folks were not necessarily fully understanding the technical issues or were deferring too much. I think the same thing with cybersecurity, where you have a lot of folks who are, younger folks, very knowledgeable about IT issues, but in order for them to have the resources, in order for them to have the backup, there really needs to be engagement from the senior staff, from the senior executives. And I think that that's one of the things that we try to do with our regulation is, when you have the CEO or the CFO or someone required to sign off on the cybersecurity efforts of the company, suddenly there's a lot of focus there. And so I think the cybersecurity challenge here is, right, I recall going about 10 years ago to a big conference that had a panel on cybersecurity, and right, the mantra was, it's not if you get hacked, it's when you get hacked. Now, that's terrible in itself, but you have to think about what is there to be stolen. I mean, it's terrible to have someone's social security number stolen, but in order to monetize that, you have to take a number of other steps. There's a possibility for the person to protect themselves. There's, there's credit monitoring. There's different things that you can take for that person to protect themselves. The challenge with crypto is, if you're a crypto custodian, and I think most of our banks are wisely recognizing that it's very challenging to build from scratch a custodial effort by the bank. And I think a lot of them are using the expertise of, licensed companies that are custodians that have been doing this for a while and have built a system from the ground up. Again, the risk there is, if your attitude is if, when, not if, I mean, that may be, if you think that that's unavoidable, if you're not striving for perfection, my understanding is, I think the estimate is, 10% of all Bitcoin has been hacked already, right? It's been lost to hack attacks. 10% has been, and then people have lost another 10% because they lost their password. And so that's another aspect of the operation that you need to be very careful about. I mean, I think that the image that captures for me the situation where we're in, where this system is so, it's a global system, and the money can be moved offshore very quickly, and the money can be lost. So one of the key things that we focus on is incentivizing good conduct. I think people are familiar with the concept of the cold wallet versus the hot wallet, right? The hot wallet is the wallet that is available for the institution to do transactions to meet expected needs. And if it has assets that are probably going to be sticky assets and be held in custody for some amount of time, you want those to be in a cold wallet. You want the vast majority of the assets to be in a cold wallet. And the cold wallet is one that is as hugely insulated from the internet as possible. So in some sense, it's amazing. It's like it's so efficient that you have to do the exact opposite, where you almost, many of the systems don't rely on technical answers for how to do that insulation, because again, it's an imperfect computer world. It's a dangerous internet. So they rely on human beings, right? The circuit breakers for this hugely efficient technology is human beings taking assets out of cold storage. You have these keys that are divided up amongst multiple people. You need multiple people to participate. Sometimes people on various continents. They're very widely separated to create that. So if you think about it as, you have a car, you put it in the garage, the cold wallet version of the garage, it doesn't have a door. You just pour concrete over the entire garage. And if you want to get in there, you need a jackhammer. You need people with jackhammers to come in, take the concrete off, and then you can get it out of cold storage. And again, you wouldn't necessarily have that attitude in the regular banking world, in the regular securities world. In fact, there's a lot of, I think, potentially negative incentives that were created at one point by the securities world expectation of immediate access to your assets. That sort of pushed, some exchanges. I think there was an incident overseas that I think was related to this, where the company had been sanctioned for not being able to make assets available to its customer in a timely fashion. And so they put more money in the hot wallet, and the hot wallet got hacked. And so I think we have to be very careful as regulators to have the correct incentives for protecting customers and making sure that the businesses are aware of these high risks and protect themselves by taking the extra step. And I think this is the point where we're at. I think if you're interested in pursuing virtual currency business activity, I think it makes sense to deal with a regulator that now has a lot of experience, has dozens of chartered or licensed companies, and has a visibility as to the creativity required to develop the appropriate cybersecurity, the appropriate BSA/AML. I think BSA/AML is a very challenging situation. I think that I take the Congressman's points to heart, that the current system that we have already has a lot of flaws and gaps. I mean, I think I read this on Bloomberg View one time. The columnist is Matt Levine. He said, well, think of it as if you're a bank, the Greyhound bus equivalent, okay? You don't only have to know, your customer is going to go from New York to Miami. You don't only have to know who your customer is, why they want to go to Miami, and who they're going to visit. You have to know the people who's going to visit. Who are those people, and who do they do business with? And so, there's very few other businesses that would have this level of compliance effort that they've already developed. So I think it's a credit to our banks. I think we're hopeful that, the involvement of banks will help really deploy expertise that they already have in BSAML, which I think is one of the things that, as creative as folks have been on the cybersecurity side, coming from the engineering side, they really have a blind spot and a gap in understanding the level of commitment that is necessary to have a good BSAML system.
Hey, Dan, we're moving out of time a bit, but I wanted to ask one quick question for foreign banks specifically about head office versus New York branch. Could you do that in just a minute or two?
Yeah, I think that's a great question, and I think it's a challenging one to answer because it's going to be very fact specific. So, if all of the activity is happening overseas, and right, the question is, does New York have a role? I mean, is it being booked overseas? Everything is happening overseas. If you're operating in New York and you're a New York chartered institution, again, I think there's a benefit to you to coming to us and dealing with us and making sure your systems are tested and reliable. But I think it's very difficult to say, where is the activity happening? What's the involvement of the New York branch? And I think it's going to be a very fact-specific analysis, unfortunately. And so you'll need legal advice to kind of parse all of these things. And again, what DFS wants to see, if you're coming to us with a proposal, I think this is just one more thing that I want to mention is, a lot of folks look at the virtual currency regulation and the bank might say, I'm not actually going to be touching the Bitcoin. I'm not custodying. I'm not touching it. So I'm not doing virtual currency business activity. However, if you're a New York regulated bank, there's a guidance out in, I think, 2007 that also talks about new product approval. And so our perspective is, this is really a new product. There's unique risks. There's new safety and soundness risks. And so if one of our regulated banks wants to get into this area, although they may not fall, strictly speaking, under virtual currency business activity, they would still need new product approval from the superintendent in order to engage in that. So we hope you'll come to us and have a discussion.
Thanks, Dan. All right, Phil, you want to talk about the activities side?
Yeah, sure. Thank you, Doug. I want to start by saying that in my experience, the principal US regulatory issues around cryptocurrencies have been around how the existing regulatory framework applies to cryptocurrency businesses and what new or additional regulatory requirements and prudential or other standards may apply. There's nothing on the horizon in the US resembling the EU relatively comprehensive MiCAR proposal for regulating cryptocurrencies, except that a handful of states, most notably New York, have established a dedicated framework for the regulation of cryptocurrencies. The US regulatory framework is fragmented. It's in a state of flux and evolution. And there's a number of open interpretive issues and a fair amount of uncertainty as to how the regulatory framework might evolve and apply to any given cryptocurrency activity. So with that in mind, I'll talk about US regulatory issues for non-US banking organizations engaging in or contemplating cryptocurrency activities, focusing in particular on registration, licensing, and power and authority issues that such cryptocurrency activity may trigger. As I assume you're all aware, non-US banking organizations conducting banking activities in the US are referred to as FBOs and are subject to umbrella supervision and regulation by the Fed under the US Bank Holding Company Act or the BHCA. In addition, US banking offices and bank subsidiaries of FBOs are subject to federal and state banking laws depending on their license or charter. And finally, non-bank affiliates of FBOs may be subject to state licensing and regulation or registration and functional regulation under the Commodity Exchange Act or the US securities laws. So when you're thinking about US regulatory implications from a contemplated cryptocurrency activity or from an investment in an entity that conducts cryptocurrency activity, you need to consider the potential implications in the various US regulatory regimes that may apply. And the US regulatory analysis would depend largely on the type of contemplated cryptocurrency activity or investment, which entity within the FBO's organization would conduct it, and what is the US nexus of the activity or investment, if any. Other panels have talked about some of the sort of business cases and activities that you may be interested in engaging in. So the principal ones are custody, use cases for tokens to facilitate payments, clearance, and settlement, And there's trading activity, and that could be proprietary trading, agency trading services, or operation of cryptocurrency exchanges. And on the trading side, you could be trading spot, or there could be crypto derivatives, borrowing and lending of cryptocurrencies, and margin lending. So the analysis of whether the organization has the appropriate licenses, power, and authority under US law to conduct contemplated cryptocurrency activity should probably start with the BHCA. And as you know, the BHCA generally prohibits banking organizations from engaging in activities other than banking or managing and controlling banks, which is subject to a number of exemptions. So although not entirely clear, agency transactions in cryptocurrency and cryptocurrency custody services should be authorized under existing exemptions from the BHCA activity restrictions. There are implications under the BHCA, however, for principal and dealing activities, as well as investment in cryptocurrency companies. As was mentioned already, cryptocurrencies are generally deemed to be commodities, and the BHCA generally prohibits proprietary trading in commodities. Also, proprietary trading in cryptocurrency may have implication under the Volcker Rule, which, as you know, is part of the BHCA. But while cryptocurrency that is a commodity appears to be outside the definition of a financial instrument for purposes of the prop trading prohibitions of the Volcker Rule, derivatives that are based on cryptocurrency are in scope, and the uncertainty around potential treatment of certain cryptocurrencies as securities also gives rise to potential Volcker compliance risk implications. So US banks are subject to the BHCA on their worldwide operations, and so they're generally prohibited from trading in cryptocurrency for their own account. For FBOs, the BHCA also applies extraterritorially, but non-US activities of FBOs that are qualifying foreign banking organizations, or QFBOs, are generally exempt from the non-bank activity restrictions of the BHCA. And as you probably know, a QFBO is an FBO that does mostly banking business and mostly outside the US. So cryptocurrency activities conducted by a QFBO wholly outside the US should be permitted and have, under the BHCA, there should be no implications. Importantly, however, an investment in a non-US entity engaged directly or indirectly in US cryptocurrency activities must be permissible and authorized under the BHCA. So then a key question is, what is a US activity and what are the BHCA implications associated with cross-border cryptocurrency activities into the US? And as a general matter, the BHCA does not prohibit or does not impact cross-border cryptocurrency transactions, because the activity restrictions of the BHCA do not apply in the cross-border context. Certain cross-border activity, however, does raise potential implications of the BHCA. So, for example, the Volcker Rule could have implications to cross-border, cryptocurrency related activity, where the subject cryptocurrency is a security or the transaction is a crypto derivative. I should note that the so-called TOTUS exemption for trading outside the US should generally be available for QFBO's cross-border transactions in crypto securities or crypto derivatives. Cross-border investments, however, into a US cryptocurrency company as well as non-US entity engaged directly or indirectly in US cryptocurrency activity raise potential implications of the BHCA and may require prior notice or approval by the Federal Reserve. And if the cryptocurrency activities of an investment target are not permissible under the BHCA, the FBO would generally need to limit its investment so that the activities of the target are not attributed to the FBO. So if the target is an entity in the US, that generally means that the FBO needs to limit its investment to 5% in reliance on an exemption under Section 4C6 of the BHCA. If the target is outside the FBO, investment in the target generally must be non-controlling. And for FBOs that are financial holding companies, there's another avenue of potentially investing under the so-called merchant banking authority, which provides authority for passive investments in cryptocurrency businesses whose activities are not otherwise permitted under the BHCA. In addition to permissibility issues under the umbrella framework of the BHCA, an FBO must consider whether offices and entities that are part of the FBO's organization, that is entities that the FBO directly or indirectly controls, have themselves the requisite licenses, registration, and authority to conduct the subject cryptocurrency activity. US banking offices and bank subsidiaries must be authorized to conduct the subject cryptocurrency activity under the applicable state and federal banking law. So federally chartered banks and branches generally must have authority under Section 24(7) of the National Bank Act and regulations and interpretations of the OCC. I think Doug mentioned the OCC interps last year regarding crypto custody, and now in January regarding the ability of federally chartered banks to facilitate cryptocurrency payments by acting as nodes on distributed ledger. So these provide helpful clarity for certain cryptocurrency activities of federal banks, and by extension, federally chartered branches. But federally chartered banks and federally chartered branches do not appear to have authority to invest in or deal in or otherwise hold cryptocurrency for their own account. Also, banks have limited power to provide services with respect to securities and derivative transactions. And so US bank subsidiaries and branch offices of FBOs most likely would need to push out to non-bank affiliates such as broker-dealers or future commission merchants any transactions with respect to cryptocurrency that falls within the definition of a security or is a cryptocurrency derivative. State chartered banks and branches must look to state banking laws to assess the limits of their authority to engage in cryptocurrency transactions. For New York, that would be the banking law, the New York financial services law, and regulations and interpretations of the DFS, including Part 200 of the DFS regulations, which sets out the New York bit license framework. And for FBOs, branches and bank subsidiaries, there's generally a prior approval requirement under the bit license framework. For non-bank subsidiaries and affiliates of FBOs that are organized under US law or whose activities have US nexus, you also need to ensure that these affiliates have appropriate registration or licenses to engage in such activities. Non-bank affiliates of FBOs that provide cryptocurrency services in the US or to US persons on a cross-border basis and that are not otherwise licensed, registered, or functionally regulated under the securities laws or the commodities laws, most likely would have to register as a money services business with FinCEN. In addition, non-bank affiliates that conduct cryptocurrency activity in the US or with US nexus would need to consider applicable licensing requirements under state law, which include principally money transmitter licensing requirements. And in a handful of states, including New York, there's a specific cryptocurrency activity license. As an alternative to a money transmitter license, a non-bank entity may seek to obtain a special purpose depository trust company charter. Some states like Wyoming and Nebraska have also enacted digital asset depository institution charters to facilitate cryptocurrency activity. As you probably know, the OCC has already also proposed to issue special purpose national bank charters to non-depository fintechs, but this initiative has been vigorously challenged by DFS and other state regulators, and the new acting controller, Max Su, has signaled that the OCC is unlikely to move forward with granting non-depository fintech national bank charters, at least not in the near future, as Su has asked his staff to reconsider all fintech initiatives taken under his predecessor, Brian Brooks. Cryptocurrency derivative transactions may also trigger registration requirements in the Commodity Exchange Act. And in addition, cryptocurrencies that fall within the definition of a security trigger complex registration and related regulatory issues under the US securities laws. The registration and related implications of the Commodity Exchange Act and the securities laws apply not just in the US, but also to cross-border transactions in crypto assets. And beyond ensuring that you have the requisite licenses, registration, and power and authority to engage in cryptocurrency activity, there may be additional regulatory requirements and standards to consider when engaging in such activities. Cryptocurrency services raise unique risk management and compliance issues in a number of areas, including cybersecurity, as Dan was talking about, data protection, privacy, and third-party service provider risk management. I think Doug mentioned the guidance that, or the proposed guidance rather, that the Fed, the OCC, and the FDIC issued last week in that regard. Most importantly, cryptocurrency activities raise elevated AML and sanctions risks, and there are a number of compliance and risk management issues to consider in these areas in the context of cryptocurrency activity. There are also operational and practical implementation issues to consider, particularly around the application of existing and new AML requirements to cryptocurrency activities. Compliance with the so-called travel rule has been particularly vexing, and also the FinCEN's proposal to require regulated financial institutions to comply with certain KYC requirements for transactions exceeding certain thresholds and involving unhosted wallets would be particularly challenging if adopted. The AML and sanction risk implications from engaging in cryptocurrency activities is a topic for a whole separate conversation. I thought I would just mention the topic here, given its importance, and note that US regulatory and enforcement authorities are very focused on compliance and enforcement in these areas. With that in mind, the AML and sanctions compliance obligations and risks arising out of cryptocurrency activities and the need to implement enhanced risk management and compliance controls to address such risks should be a principal focus in evaluating the feasibility of engaging in or investing in a cryptocurrency business. So with that, I'll hand it back to you, Dave. I'm sorry, Doug, to see if there's any questions.
Thanks, Phil. That was great. Just want to point out that I claim credit for coining the phrase TOTUS, pun intended. Now, we have a couple minutes left, so I wanted to go back to Usman. We had a little technical glitch earlier, but I did want to ask the question again about sort of, we have a good case study of the US denying ETF issuance, Canada saying yes to it. We've had that for a couple years now, and those years have been through periods of extreme volatility in the price of some of those crypto assets making up the ETFs. What has happened? What's been the reaction in Canada to that? You're on mute, I think, Usman. Still on mute, I think. All right, I think technical difficulties continue.
Can I just mention one thing in response to that? It's not just about the price volatility. I mean, I think this SEC's hesitance is there really isn't a market manipulation oversight authority, right? For options, you have ORSA, you have a lot of people, a lot of eyeballs looking at it. And, DFS requires our companies to take a real look at market manipulation issues. But a lot of trading is, is overseas. A lot of trading is accused of being wash trading. There's a lot of accusations about price manipulation. Until we get around, it's a global problem. So how does the SEC going to get its hands around it to get comfortable with an ETF? It's a hard question.
Yeah, you're right. Yeah, I didn't want to, give the impression price volatility is the only issue. I was just using that as a test case between the two. With that, unless there's any other questions, I think I'll hand it back to you, Bridget.
Great. Thank you. Thanks, Doug, Dan, Usman, and Phil. It was really interesting. And that's just a glimpse of the challenges, right? But it was a really comprehensive review. And as always, we appreciate the, specific foreign bank discussion. So we're now going to take a brief break and a word from our diamond sponsor, Clifford Chance, and our sapphire sponsor, Guidepost Solutions, before our next and final panel. This sounds kind of exciting, Crypto in the Wild. So stay tuned. Hi, everyone. We're live, but we'll start this panel at 12:35. So hold on for a couple more minutes.
Thank you. Can everyone hear me?
Yep.
Great.
Sound great? Okay, welcome back, everyone. We've come to the final panel of today's seminar, Crypto in the Wild, a discussion of specific projects and initiatives. Dave Soilis, a director in Exeger's financial crime compliance practice, will moderate our panel. He'll be joined by Megan Millard, the Senior Managing Director in Guidepost Financial and Regulatory Compliance Services, Jay Masari, a partner in Davis Polk's Financial Institutions and FinTech Practices, and Arthur Long, a partner in Gibson Dunn's Financial Institutions and Securities Regulations Practice Groups. So Dave, I'll turn it over to you.
Thank you very much. So our discussion today is crypto in the wild, and during this next hour, the panel will be discussing a number of specific projects and initiatives that we've been working on to just wrap our heads around this new world of cryptocurrency and the implications for banks, both from a financial standpoint and from a regulatory standpoint. So to kick off the discussion, I asked the group what regulatory issues related to cryptocurrency do you think will give banks the greatest competitive advantage in the marketplace when they're solved?
I can start, and then others should jump in, certainly. I mean, I think the issues are similar to issues we've seen in other areas of the banking sector over the last decades or so, and namely that banking institutions will have advantages in terms of technology, resources, in-house resources, ability to spend in the areas that are critical to cryptocurrency once they are resolved, namely the know your customer and anti-money laundering issues, the cybersecurity issues. These are issues that, as we have seen in the last decade, do result in significant costs. And I think once those are resolved, I do think that the banking institutions will be well placed to have a competitive advantage. At least that would be my view.
Arthur, that's a really interesting point. I think I agree with you to some extent, perhaps disagree to another, and we can have a little discussion about that, which I think is what makes these panels interesting and fun. So, you know, I 100% agree that there are lots of ways in which banks can have a significant advantage in terms of providing services involving crypto assets, which you can define pretty broadly, right, to include things like true cryptocurrencies like Bitcoin and Ether, but also stable coins, also tokenized versions of traditional assets, right? And to my mind, you know, one clear area where I think banks have significant advantages is in institutional custody, where, you know, if I'm an institutional asset manager starting to think about investing in cryptocurrencies of any sort, I think big banks that already provide custody services to those asset managers for securities, you know, provide related FX services, other asset servicing services, will have a clear advantage because, of course, a customer is going to want to custody crypto at the same place where it custodies other assets for its clients or for itself. On the other hand, I think the banks are going to face a steeper learning curve and a bit more of a challenge when it comes to things like providing retail payment services, where you've got sort of a flourishing ecosystem already in cryptocurrency companies that started off as crypto native or as fintechs, already providing pretty broad services to retail customers. And Dave, to get to your question, I think, you know, what are the regulatory issues that need to be solved for banks to start diving into either of those areas or many, many others that they're considering, include things like permissibility under US law. You know, what activities are actually permissible and why are they permissible? Which entities within a banking group can provide services to customers involving all sorts of different kinds of cryptocurrency? What assets can be issued? What assets can be held by banks versus non-banks? I think once those issues are sorted out, banks will have a lot more clarity and will be able to start diving in headfirst instead of just dipping their toes.
Yeah, oh, that's a great point. Thank you. And just before I jump into the conversation, I just want to say thank you, Bridget, for inviting me here. It's really been a great day so far. I enjoyed listening to a lot of your speakers and really appreciate being here. So, but with that, I think you've both made some great points there. And I think, you know, to answer the question, what issues will be resolved, what will be the greatest competitive advantage to the banks? Jay, definitely, you know, if a bank is already in the custody area, if they're thinking about, you know, custody of crypto assets, they're going to have the advantage because they have customers already in place, but they really also need to think about how they're going to do that. And would they be, subcontracting with a firm that is more deeply involved in the crypto space? Like, for example, Paxos is a company that's very involved in the custody of assets. But also, I think on a bigger picture scale, the real competitive advantage is kind of having the conversation with your primary regulator so that they can kind of have an understanding of what direction you're going in. Because I think getting those regulatory approvals, once you decide that that's a focus and a focus within crypto, it's really going to take the dialogue and getting your regulator comfortable with what you're doing in this space. And if you're the first one that gets there, you've got to be the first one that starts the conversation. And a little bit of that is partially to my background as a former regulator, but I do think it really does give a competitive advantage when you start that conversation early.
Yeah, so I don't disagree with you. I suppose I think in time, I think that the permissibility issues, now they may not be worked out to everybody's satisfaction given certain views that we've seen in Washington. Although I guess I am a little bit more optimistic given actually in some ways somebody who has always liked the dual banking system, it does seem as though there has been, and it is interesting, back probably, I don't know what it was, about maybe 20 odd years ago, people were talking about reinvigorating the state charter and what you could do with perhaps using the FDIA Act for it. But and it was, people talked about it, but it is interesting that we actually now are seeing some reinvigoration of this dual banking system, and in particular for the foreign banking community, which historically there were very few federally licensed branches of foreign banks, and New York really was, the New York Banking Department then, and now DFS, really was the center for foreign banks operating in the U.S. So I do not disagree with you. Hopefully we will see the permissibility work itself out in some ways over the next few years.
We can only hope. I think.
That's what makes it interesting, right? I don't know if you heard the previous panel, but we heard a quote from Dan Sanjeev that states are the laboratories of democracy. So, interesting to see everybody's viewpoint and seeing how things will work out there.
Absolutely. And Arthur, you used the phrase reinvigoration of the dual banking system. Can you just provide a brief overview of what that is and how that could manifest for some of the attendees on this panel?
Sure. Well, I think the issue certainly as it relates to virtual currency is we have had some each state under its banking law can determine what is part of the business of banking or what is a fiduciary relationship, putting aside specific licensing. But so we have, and in terms of reinvigoration, I think we have seen over the last decade or so, maybe more, many banks moving towards an OCC national charter, and even some foreign banks. But with virtual currencies, we have seen states taking leads on some issues about what you actually can do as a banking institution or a trust company. And indeed, for the foreign banking community, a branch of a New York bank, for instance, can exercise all of the fiduciary powers of a New York state chartered bank. And so depending on where things fall down at the federal level, and of course this depends on particular supervisors, but certainly we have seen the growth in the virtual currency activities have come out of interpretations of state charters in a way that people were thinking, oh, I'm going to get a national bank charter because I can do preemption, blah blah blah. 10 or 15 years ago, you're now seeing return to some state licenses, and indeed foreign banks, as I say, do have the authorities of a New York State chartered bank or trust company.
And Arthur, maybe I can add one point on that. There may be a bit of a different avenue for foreign banks, but just something to be aware of. I think we're also seeing charter innovation in a really interesting way, not just interpretations under existing types of charters, right? We're seeing, for example, in Wyoming, the Speedy Charter, which was and is contemplated as a special purpose charter for crypto custodians and for banks to provide payment services involving cryptocurrency. And we have two firms that have provisionally received charters. I don't think either is actually operational. You guys can correct me. But that's a very interesting charter innovation, because that kind of bank is a bank and can, in theory, become a member of the Federal Reserve System, which I think is an interesting feature not available to, say, a mere New York trust company, and potentially pretty powerful. At least we haven't seen much of that yet in the crypto trust companies.
No, I think you're right. I mean, I think and you're right too. I mean, the payment system, of course, is under review. Yes, I mean, we will have states like Wyoming that are becoming the new Utahs. What Utah is to the industrial bank, Wyoming, perhaps the whole banking system will be migrating to the Rocky Mountains, which would be interesting. But yeah, I agree with you.
Well, I also think Utah is also the new Utah, because Square is an ILC. So there's innovation within the bank regulatory system and how different types of fintechs and cryptos are approaching them, right? So it's all interesting to see what works. I think it's what works for your products, and kind of thinking outside the box within the box of regulation.
I think those are some really interesting points, and there is absolutely innovation in this space from a regulatory standpoint. And Megan had mentioned earlier in the discussion that there is a certain element of making a regulator feel comfortable, with cryptocurrency in general, and with any sorts of innovations to a compliance program or legal framework that's built up around cryptocurrency. So I'll just pose a question to the group, kind of open-ended, but what sort of strategies should be employed, in general, to make a regulator feel comfortable with cryptocurrency, or really just with something new for a bank and a new business line? Are there any strategies that you've seen in your careers that have been effective in terms of getting regulators comfortable, and could any of that be applied to cryptocurrency?
Yeah, I mean, I would just say that I think at this point in time, I've been in the bank reg world for over 15 years. And in the last 2 or 3 years, I've never seen anything like it, that regulators have innovation hours and innovation offices and, reg sprints to have different companies come into the regulator and show them what the innovation is looking like. And I've just never seen that sort of thing. And maybe it is what I alluded to earlier, but you know, I think there's a bit of like a very much of an open door situation with all the regulators. They want to hear about what you're doing in the innovation, but also, of course, the controls that you have in place, right? And the idea that you're looking at the innovation at the same time you're looking at controls and you know, BSA, AML kind of focus, KYC, all of those things, that you're thinking about that at the same time as thinking about the innovative technology.
I think those are all really great points. Maybe I'll make a few sort of glib assertions and then talk about them a little. One is that I think there's a huge tension here, right? Between, and I think banks are probably less prone to this than, say, tech companies or fintech companies, but big announcements, right? Using the word blockchain and crypto many times with lots of exclamation points. You know, there's a real tension between getting the buzz and getting sort of the outward facing excitement about a particular offering or a particular product versus how to present that appropriately to regulators, right? I think in general, banks like to think about how they're providing services in a technology neutral way. And there's this, you know, concept that I think gets thrown out a lot, around a lot, including in the regulatory community, about technology neutral regulation. Like, that is a huge challenge in the cryptocurrency and blockchain space because, frankly, there's been tons of problems, you know, starting with financial crimes, but not ending there. And so I think banks are served well by sort of moderating themselves on the punchiness of their press releases and thinking about how regulators are going to view those announcements and focusing on how the technology really is used and how it reduces risks, in addition to how risks arising from that technology are addressed, and all sorts of risks. But I think that is a hard discussion. Anytime you talk to a regulator and the word blockchain is mentioned as part of the discussion, you get, instead of the 5 people you would expect, you get a cast of hundreds because of the interest in the technology.
Yeah, I think just adding to that, I think the other point is, and it cuts both ways given the particular product issue, but if you, and I saw this more in the blockchain area than virtual currency, but they are of course related. If your particular solution is something that will help regulators with areas that they are currently charged with doing, so hypothetically creating, some sort of settlement system that in an area that they might be interested in, you certainly will get interest because as Jay said, they do want to understand the technology. It will aid them with their own regulatory analysis, and that is certainly something that and help them as supervisors. Conversely, if what you're doing is more disruptive to their tasks, which some of this is obviously, maybe a different result.
Yeah, and I think it's such an important thing, and it's very hard to do this when the business side of things is moving at such a fast pace. But kind of bringing that to the regulator before it's because you got into a tough spot with something, actually showing them your technology before you're in a difficult position and have to show them the technology. I think you get a room full of people because they're human beings too, and they want to know what's out there just as much as everyone else wants to know what's out there. And if you can bring it to them and do a demo and explain why it works for you before you're called in, I think it goes a long way.
I completely agree. The business is very fast paced now, and it does seem like there is regulatory openness to have those preemptive conversations with compliance departments conducting demos of what they plan to do. So I know on the Exeger side, we've gotten a number of inbound requests this year related to assessing controls in place for the eventual adoption of potential crypto exposure. And I think assessments along those lines can be really helpful in terms of explaining to a regulator what you've done already before you even know exactly what the business plans to do, because as has been mentioned, those plans are often in flight and can change very rapidly. So kind of pivoting off of that point, I'd like to hear the panel's thoughts on the forms of exposure that banks already have to cryptocurrency, even if they aren't offering, direct custody of crypto assets to their client base. What sorts of exposure is currently out there that probably impacts the folks listening on this panel right now?
Yeah, I think it's an awareness, and this is where banks, even if you are not directly banking a cryptocurrency firm, you are probably in some way banking crypto. You might have a customer who is accepting crypto payments, right? Like we've recently seen in some auction houses, they're accepting crypto. Well, if your customer is accepting crypto, you really need to kind of reassess your KYC questions, your risk assessment, looking at if a customer is accepting crypto coins, are they only accepting certain coins? Have they done a risk assessment for their coins? And these are all questions that, I think banks just want to be asking the right questions to get the answers, because nobody's really going to volunteer that information unless the questions you ask at onboarding and your continual monitoring are the appropriate questions. People aren't necessarily hiding it, but they're not going to, just present the information unless you dig in a bit.
Yeah, and just to build on that, Megan, I 100% agree with what you're saying. I think, what we've seen in the past, I don't even just 6 months, is a significant increase in the willingness of banks to provide what I now call traditional banking services, right? So not themselves touching crypto, but provide deposit account, savings account, transactional account services, treasury management services, and the like, involving non-crypto assets to companies who are heavily engaged in cryptocurrency businesses. So I'm thinking about the cryptocurrency exchanges, the OTC dealers, the custodians of the world. And clearly there is a lot of, I guess, what we could call indirect exposure to cryptocurrencies, right? Because I think by default, banks have been treating those types of clients as high risk clients subject to enhanced due diligence requirements. And in truth, the world is quite complex in this area, right? Because the risks of different types of tokens are different, as you alluded to, Megan. Even now, right, even the last 6 months, I think the risk of Ether is now quite different than the risk of Bitcoin, largely because of the rise of DeFi applications and the enhanced utility of Ether for anonymous transactions involving all sorts of other coins. And so I think it's really a challenge for banks to first keep up to date in terms of the technology and what the market is doing, but also to try to figure out how best to assess the risks from this type of indirect exposure. And that's not to say it can't be done or shouldn't be done, but it is a bit different and exciting, of course, as well.
And another great question is, within the cryptocurrency space, I think there are two roads that companies are going down, and many of them really want to be regulated and go toward the regulatory with an open mind. And then there are crypto companies that are just trying to avoid it at all costs. So for a bank, they really need to dig into that when they see if they're banking that an exchange or some sort of crypto related company in traditional banking. In a way, it brings me back to the correspondent banking issues we've had in the past.
Yeah, I think that's right. I mean, I think there has been a development, certainly recently, so that you're instead of answering questions like several years ago, like how can we get a bank account if you're representing a crypto firm and telling them, well, we're not sure we have a great answer for you. I think and that makes sense because I think some of the compliance issues and risk issues are probably easier to solve at the institutional level in the first instance than a retail level.
I mean, Megan, to your point, it's such a good one, right? And we've seen the evolution of due diligence questionnaires used by banks. To my mind, it's hard to justify any other question as the first question being, what licenses do you hold to engage in your business, and do you have all the licenses you need? Because it is just not true that cryptocurrency activities aren't regulated, at least in the United States. And in many other jurisdictions as well, at least with respect to AML regulation. And I think that is clearly the first question that banks should ask when they're onboarding a crypto firm to provide traditional banking services to them.
Yeah, and especially because this field is growing so much that we're also getting to a point where you can't just say every crypto company is high risk and needs enhanced due diligence, because your regulator is not going to appreciate that either, because you're diminishing the idea of why you're doing enhanced due diligence if you just do it for all, right?
Yeah.
So because the field is like exploding, it really needs to be the focus there and figure out where things are within the world of crypto if you're banking crypto.
That's a great point. I think you could see an expansion of BSA, AML, and OFAC risk assessments to include specific types of cryptocurrency companies and specific types of coins, rather than lumping them all under one umbrella, because not all coins are the same, not all cryptocurrency companies are the same. So that's absolutely something that you can anticipate evolving within a bank's AML and sanctions compliance program. And I felt like the correspondent banking comment was really interesting as well, that this is somewhat reminiscent to that. And we've seen that the Wolfsburg questionnaires and the forms of data collection regarding correspondent banking have expanded significantly. I think the questionnaire is of over 140 questions at this point. So you could also potentially see some sort of industry group, virtual commodity association, coming up with a list of questions akin to a Wolfsburg questionnaire that can help banks navigate, risk identification in a somewhat standardized way. But of course, we don't have that yet. So, it'll be on banks to develop their own internal best practices, at least for the time being. One other area that I think is very top of mind for banks is just a partnership model between banks and fintechs, which are already well enmeshed in cryptocurrency services. And in terms of evaluating what sorts of partnerships are suitable or effective or within risk appetite, I'm just curious if if the panel has any strategies for dealing with that, or for giving a bank the tools to start answering those questions.
I mean, this is a great topic because, at least in my practice, I've seen a huge increase in interest in these kinds of partnership arrangements. You know, tying back to the very first question, Dave, that you asked about permissibility, where there's uncertainty about whether particular activities are permissible. For example, providing your retail deposit clients access to cryptocurrency accounts to hold and buy and sell Bitcoin, for example, where banks aren't sure that they can provide that service for themselves, either because of a legal permissibility question, or frankly, they're not yet familiar enough with the technology. They don't feel ready in terms of risk management to provide those services directly. We have been seeing banks consider and actually implement, at least here in the United States, partnership models with what I call the crypto native firms, right? So these are firms that have grown up providing institutional and retail cryptocurrency account and buy, sell, hold services to customers, are licensed, to do those activities generally under state-by-state money transmission licenses, plus the New York BIT license. And banks are, thinking about how to partner with those firms to provide seamless, integrated Bitcoin account services, along with bank deposit services, sometimes securities account services, to think about what Robinhood does, right? But a bank doing that, or a bank affiliated broker dealer doing that through a partnership model. And I'll leave it to Megan and Arthur to fill in some of the blanks about the challenges there, but of course there are challenges, right? This is a new type of partnership arrangement with a new type of partner that needs to undergo, the normal vendor due diligence that a bank would always do on any of its partners. And given the special challenges of crypto, there's going to be a big focus on risk management, safety of customer assets, and financial crimes compliance.
Yeah, and I think this was also a great next question, because a lot of our earlier conversation kind of built on the same foundation. Definitely the partnerships are there, and the regulators are kind of issuing guidance to say, it can be done. But I do certainly think that your onboarding and kind of risk management, it really needs to be like a deep dive, getting in there and understanding what those payment companies are actually doing before you start to to put together the framework for the partnership. I think a lot of what we had previously said kind of also applies to this question. And a bank might want to consider having a few more additional people if they're earlier into this kind of partnership framework, maybe adding a few more people than you would normally have at your introductory meetings and onboarding, and kind of reviewing if the traditional questions really are still enough.
Yes, I think that's right. I mean, I think that until there probably is sufficient overall clarity, which is going to take, will take time, the sort of underlay of, the supervisory underlay that the bank regulators, which is the other part of their main job, which is only, increased in intensity, with Dodd-Frank, it is going to continue in this area because there are so many questions. So it is a more challenging area, perhaps, than other partnership models that we are used to seeing in the financial services sector.
That makes sense. And one area that I've seen is that there are certain core aspects of compliance that I think financial institutions don't even think about so much anymore within a bank-to-bank relationship, that will need to be front of mind again when entering into potential relationships with some of these crypto native fintechs. It was mentioned on an earlier panel, but the travel rule is an example of that, where that rule was designed in the mid 90s, far before cryptocurrency was even considered, and the travel rule does apply to cryptocurrency. So, there are areas like that where the travel rule has reasonably just been, the technological framework for addressing the travel rule has largely been solved from bank to bank. But, if any of these fintech partnerships are integrated, that will have to be top of mind for the AML compliance officers at a bank to make sure that they have a defensible framework that they can show to a regulator and have the regulator be comfortable that they're complying with their requirements. So I think there are probably other areas like that where banks just don't think about innovating in as much anymore, but they will need to with these crypto partnerships, and that'll be a really interesting time and challenging time for the compliance departments to figure out how to do that. So get excited, everyone who's listening.
Yeah, and Dave, oh, sorry. Oops, go ahead, Megan.
Well, I just think that is that is a topic that gives a lot of people a lot of angst. But just asking the crypto or crypto related fintech if they've thought about it, and if they have, because there aren't solid solutions right now, but there are blockchain associations that are dedicating a ton of time to trying to figure out the solution. And if you ask the question, and whether you're face to face or what, if there's like a blank stare or like nothing in the works, then maybe that's a red flag.
Yeah, that's such a good point, Megan. I think we may not have a full solution at the moment, but I think the industry is working really hard to figure it out. I think though, as a practical matter for banks, right? The way that they need to, as you said, the travel rule is now, not whenever the industry figures it out. And the way banks are, at least in my experience, thinking about this and dealing with it is just taking baby steps, right? Even in the partnership model where, they're not facilitating their own customers, trading, a ton in these cryptocurrencies. It's a buy, sell, hold service, or to state the obvious, they're not facilitating customer transactions, like sending them away to DeFi aggregators. Like they're not going to be doing those, providing those services or facilitating those types of transactions anytime soon, because it's too hard to get comfortable, I think.
Definitely, I agree.
So thinking about where things could continue to go, I've just got a couple of questions for the panel. And the first one, I guess there's no right answer to this yet. I'm just curious about everyone's opinion, but do you think cryptocurrency at the end of the day will end up being regulated as a security, as a currency, as a commodity, as something completely different? Where do you think this ends up in 5 to 10 years?
Well, the safe answer would be yes. But I think, I think a lot of it depends. I think that's what makes this very interesting as a policy matter. Depending on, a lot of it will depend on what happens in Congress and Congress's desire to get in, and it would also it's actually a great test of the Dodd-Frank, FSOC framework for evaluating new activities, and getting the regulators to work together, towards something. I do think that there will be, certain virtual currencies do have aspects of securities. I expect some of those will end up migrating to ATSs. I could be completely wrong about that. On the other hand, and some of it also raises very interesting questions about regulatory interpretations under the various statutes. Exchange coin and bullion. I mean, if something is called Bitcoin, it's not bullion, but is it exchange? That's part of the business of banking. So I have to see what Congress will do, but you do have, at least at the SEC, a very energetic chairman who's not afraid to get into important issues, as we saw actually with when he was at the CFTC. I guess that's a long way of saying yes.
So I agree strongly with Arthur, perhaps with a slightly different spin on the yes, right? I think yes means yes in this case.
Yes means maybe.
Yeah, exactly. But I think right now, right, there's this perception, and I think it's somewhat warranted, somewhat not warranted, that either you fit a cryptocurrency into a particular category. It's a security, it's money, it's a commodity, and therefore it's regulated. That's not really the case, right? To be honest, if a digital asset is a security right now, that kills it, right? It's not just regulated. It's like you can't meaningfully use it for its intended purpose, right? If it's a commodity, it just means that it's subject to anti-fraud, anti-manipulation enforcement authority. It's not really regulated by the CFTC. If it's money or a convertible virtual currency, right? It's activities involving that token are subject to money services regulation by FinCEN and by the states, but it doesn't mean that it's subject to market regulation if it's, an exchange is trading it, right? And so what I think we're going to see, right, is instead of like a binary decision, for example, on the SEC's part, whether something's a security, then it's regulated as a security and that's it, versus no, and it's like sort of just out there, you're going to see regulation of these tokens based on the sort of how they're being traded and how they're being used in the market. So exchanges that are providing real markets, like order book markets, are going to need to be functionally regulated that way to provide orderly markets, transparent markets, to mitigate conflicts of interest between market participants and the like, right? So the answer is going to be yes. The question is, what does that yes look like? And I think it's different than it is now.
All right, so I'll agree with the yes as well. And I just think that this is a huge industry and not all coins are used for the same purposes. And I think that it's going to become more clear. We have the advantage of being the last panel. We've had a whole day full of different types of regulation that's being discussed and regulation that's in place. I think it's got to take a turn. We have stable coins. We have central bank digital currencies. The Bahamas has a sand dollar that is actually in use. This industry is too big to say that it's going to be, it's either going to be a security or it's going to be a currency. I think there's room for all, but it has to somehow, it all has to get worked out. So, maybe that will be this panel in 2022.
Yeah, I think as a compliance officer, you can come out of a panel like this or a conference like this with your head spinning in terms of the potential uplifts you may need to make to your program and the current ambiguity that is out there as the regulatory framework gets developed and codified. But I think my only advice would be you're not alone, and the regulators' heads are spinning too. So they will there will be guidance, more concrete guidance coming down the pike. I think we can pivot to Q&A. We've had a couple of questions that were submitted so far, so we'll just start with those and kind of building off our most recent discussion. There was an attendee who asked, what do you think the enforcement landscape for banks in this space will look like? So I'll pose that question to the panel. It's a simple question.
I think it's a little bit, like we're still like on a first date. And, trying to, I think regulators want to see where that banks are trying to build an appropriate control framework. I think those first enforcement actions are not going to be those where the banks are trying and are building. Because there are plenty who aren't there. I think you've got your regulators are going to find kind of the banks that are really out there, outliers, and that's going to be relatively easy. So right now, I think we're a little bit like really in love, but I don't think it's going to stay that way. So banks really need to think about it now before they get that phone call. That's my take right now.
Maybe I can answer a different question. I guess that's the prerogative we have as panelists, right? Which is, I think what's really interesting right now is not enforcement related to banks and bank activities involving digital currencies, but instead the broader enforcement environment, which I think is really heating up. I think many of you probably saw the New Jersey Attorney General got in the action today with a cease and desist against a cryptocurrency company for offering a yield-bearing product. I think we're going to see a lot more of that. And it's going to be securities-related regulation, potentially banking-related regulation, all sorts of enforcement across the industry. I think we've started to see that really heat up in a meaningful way now. And I think probably the way banks can think about it is they should be looking and seeing what's going on out there so they can know what to avoid and potentially where the opportunities are, to be honest.
Yeah, I think just to add on to that, I think, having worked on a fair number of, or at least at the time, they've seen innovative products before the financial crisis for non-US banks, and seeing what has happened since, for the entire banking industry as a result, but there is much less tolerance now for error, even good faith error. Good faith error can be punished fairly severely. And I think the issue as banks get into this, making sure that every T is crossed and I dotted with respect to risk management. Have you vetted all the risks of these products? Are these, to the extent this becomes less institutional, what are the suitability issues? What are your dealing with your clients? What are the fiduciary issues to your clients? All of this is going to be scrutinized extremely closely, and I think to avoid substantial enforcement, actually getting the legal and compliance right from the get-go will be very important.
That makes sense. There was a second question from the audience, which asked, or stated that a previous panel mentioned cross-border benefits. What do you think are FBO unique risks and benefits?
Well, I'll give one, which is sort of a traditional one. FBOs who have U.S. operations, particularly substantial U.S. operations, have two masters. They have the home country supervisor and the host country supervisor. The expectations at some point between supervisors can sometimes differ in some degree. And even if they differ in a marginal degree, you don't want to get caught, particularly in the host jurisdiction here in the U.S., not rising up to the level of the U.S. Supervisors, particularly when it comes is the case of a newer innovative products.
To echo what Arthur, oops, sorry, Megan.
Go ahead.
To echo what Arthur's saying, I agree with that a lot. And I think particularly in this area, there are likely to be quite different views inside the US and outside the US about what is appropriate for banks to be doing. I think we see a lot of innovation in Asia and in APAC in general that we don't yet see here. I think the regulators there, frankly, are a bit ahead. I think you even see it a little bit in the UK as well. And so I think, foreign banks should be quite careful when expanding those activities into the US, because the answer outside the US is not always, and often in this area, is not going to be the same as inside the US.
Yeah, I completely agree. And I think, the issue that Arthur brought up has been an issue for many years, not just in this space. And another issue that I think has been an issue for many years, not just in this space for FBOs, is your sanctions policies. And, just really watch for what you have in place and make sure that, with crypto companies and fintechs, you've also really got to make sure that, you're watching IP addresses and different types of risks, even more so in this space as an FBO.
That makes sense. I think, as cryptocurrency is already a bit of a lift for regulators to work through. So adding another variable of potential high-risk jurisdictions does, make that lift a little heavier. So just thinking through how to mitigate the risks and have a reasonable plan for if those foreign individuals or entities, gain access to that sort of product, I think is very important. Well, I don't see any other questions from the audience, so I would like to thank the panel for the great discussion today. Everyone's experience really shined through, and I felt like there was very actionable feedback for our participants on the call. It was really great to have this discussion, and I will turn it back over to Bridget.
Thank you. Thanks, Dave. Thanks, Megan, Jay, and Arthur. Yeah, actionable feedback. There's definitely plenty to take action on and to think and worry about, but also so much, really to look forward to. I thought beginning with Jim Kuna's presentation this morning that sort of laid out this very comprehensive overview of everything that the Fed is looking at, and then working through each of the panels, hearing from Congressman Davidson about what might big quotation marks happen on the Hill. Really, there is a lot to be watching in this space. So thank you to the panelists, and I hope all the attendees found today's seminar to be as helpful and informative as I did. So again, we want to thank all of our speakers, amazing expertise. Really, the IIB is very lucky to have you join us today and serve as resources to us throughout. And thanks to all the members and attendees who submitted questions. Appreciate that as well. We also want to thank our sponsors, our diamond sponsors, Clifford Chance, Davis Polk, and White and Case, and our sapphire sponsors, Exeger, Gibson Dunn, and Guidepost. Your support of the IIB is invaluable and really allows us to provide quality programming such as today's event to our members. And with that, the IIB's virtual seminar on digital currencies has come to a close. We look forward to continuing the conversation on this complex and rapidly evolving topic. Thanks, everyone.